there in terms of the current account, the domestic savings rate, they're all pointing to dollar weakness. They haven't played out in a period of geostrategic uncertainty. And my guess is if we ever get through this war, once we're on the other side of geostrategic uncertainty, the dollar's fundamentals will reassert themselves. It won't be the end of the world, not the demise of the dollar's status as the reserve currency. But, the dollar's had three major corrections since the early 1970s. And these are big ones. They average close to 30% on a trade-weighted basis. And each time they've been triggered by, either inflation, geostrategic uncertainty, or some other type of financial event that afflicts the world, but the U.S. a little bit worse than the rest of the world. And, there is that possibility, and I wouldn't rule it out. We're setting ourselves up for dollar weakness. Whether that setup actually gets triggered remains to be seen.
Stephen, great to catch up, to hear from you, as always. Stephen Roach there of Yale University. Tom, short in the US dollar, it's tripped up a lot of smart people.
It has, and what's fascinating about this is when there's a new Louvre Accord, which we may get with strong dollar, it's another excuse to visit Paris for the team. We can go to the Louvre and they can do
Euro tour.
Louvre Accord number 2
right?
on our tour. Yeah, but this is a really important point for global Wall Street, and as Dr. Roach says there, we've had these once-in-a-lifetime events get in the way that have allowed for dollar resiliency, as Mark McCormick talked about yesterday, or think of David Bloom, ex-HSBC.
I want to be careful not to mischaracterize the call from Bank of America. Not my position to advocate for them, but I will quote them, though. Our forecast point to inflation peaking this quarter and falling steadily into 2023, not exactly vanishing into thin air. They go on to say, we believe this will reduce the panic level around inflation and allow rates to decline. One view, Lisa. Another view makes a market. That's the story.
And a lot of people are saying that, you have on one side of the market, to use your words, that you do have people who are saying the Fed isn't being aggressive enough. And then you have others who say, yeah, fat chance they're actually going to get above 2% in terms of the Fed funds rate.
That's what makes this job interesting sometimes, right?
Sometimes,
it's very interesting now.
Every day.
Yields are lower by 7 basis points on a 10-year to 286.86. In the equity market, we're positive a 1/10%. And Netflix somewhere getting absolutely hammered. It's down and down hard in the pre-market. We are lower by around about 25, 26, and now 27%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned a small but growing number of senior Kremlin insiders are quietly questioning Vladimir Putin's decision to go to war. They believe the invasion was a catastrophic mistake that will set the country back for years. Chance the Russian president will change course and no prospect of any challenge to him at home. In Shanghai, businesses from car makers to supermarkets are gradually resuming operations in the midst of that massive lockdown. Many factories are able to restart by using a closed-loop system where staff work and live on site and undergo regular testing. Health officials say that 2/3 of Shanghai's 25 million residents are still locked down. And Elon Musk has given fresh fuel to speculation he would launch a tender offer for Twitter shares. The billionaire tweeted a message with a blank space, followed by the phrase, "is the night." The missing word could be tender, as in the book by F. Scott Fitzgerald. Twitter's board has yet to make a formal response to Musk's $43 billion takeover proposal, but it has adopted that poison pill provision to defend against it. And the largest public pension fund in the U.S. plans to vote for a shareholder proposal to replace Warren Buffett as chairman of Berkshire Hathaway. California Public Employees Retirement System has about $2.3 billion in Berkshire shares. It's backing another large shareholder who has called for an independent chair at Berkshire. Buffett is also the CEO. Berkshire opposes that proposal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
If you're a high-risk person, yes, there's always going to be a COVID-19 risk, and you have to continue to think about wearing masks in high-risk situations. I don't think airplanes themselves are very high-risk situations because of the number of air exchanges that occur, but maybe the subway, a bus might be. But remember that one-way masking works.
Dr. Amish Adalja there, the senior scholar at the Johns Hopkins Center for Health Security. Equity futures this morning up about 0.1% on the S&P, on the Nasdaq 100 down 0.1%. Into the bond market, yields are lower by 7 or 8 basis points to 286. Netflix is down about 27%. We'll revisit that
27. Who's counting?
in just a moment. And Tom, we need to revisit this from the president of Russia, Vladimir Putin, taking part in a session of the supervisory board of the government.
John, this is so important. As Greg Villiers and others have published this morning, we don't know of the young sailors on the boat that went down in the Black Sea. And we've had a media tour while you were gone, John, of Mr. Putin from a cosmodrome to an economic Zoom meeting. And now, and I'm not sure we're going to see this on radio, he's in a large room with some people socially distanced from him, not too far away. And John, there's a bunch of kids here asking questions. I'm absolutely fascinated by this media campaign amid war.
Well, Tom, you've asked the right question. We don't know what's going on. So let me ask a question. Do they know what's going on within Russia? Do you think they know the fate of those sailors?
I would respectfully suggest that the power of media is X% no, et cetera. For those of you on radio, it's getting sort of zoomy now. We're going to leave this right now and move on to masks and such. But again, Mr. Putin out, and we'll continue to monitor those headlines as well. With Johns Hopkins University, someone who's been a huge value to us through the pandemic, Bhakti Hansadi joins us this morning. Bhakti, what is the science of CDC or Mr. Biden saying, wait a minute, we want to appeal this legal process to put masks back on our face forget about the politics of it. What's the science of us putting masks on our face?
So the science is very clear. We know that masks prevent transmission of COVID. We know COVID cases are going up. We do also know that COVID deaths are not going up. So is it really, the question is, do we still need masks? Is this still a necessary precaution? And it's all about science, but about weighing the risks and the benefits.
We're disagreeing at the moment over what to call it. Delta Airlines put out a statement about removing the masks, and they referred to COVID-19 as, quote, an ordinary seasonal virus. And then they had to edit a statement, Doctor. They've gone on to call it a manageable respiratory virus. What are we going to call it as we try and get away from what this was a couple of years ago?
Well, definitely not seasonal virus, right? Because we haven't established a seasonal pattern with COVID like we have with influenza and the cold. So not a seasonal virus. It's definitely a respiratory virus. And it does still cause some deaths. In the United States, we still have an average of 450 deaths per day. Now, that is not an unsizable amount. And so it's a potentially fatal respiratory virus that we have effective treatments for.
Dr. Ansari, have we gotten back to a place where we can talk about the common flu and talk about COVID in tandem when it comes to the mortality rate?
You know, I think we're getting there, to be honest, right? This is not the same playing field that it was a year ago. We have a high proportion of individuals who are vaccinated and a high proportion of individuals who have got Alpha, Beta, Omicron, Delta, or BA2. And that gives us some protection against severe illness. So I think we're getting close. The deaths still seem high. Our under fives are still vulnerable. I think once we cross those hurdles, we'll be in a much more comfortable position.
When do we stop testing?
When we can ensure that there is effective protection against all members of our society. So the reason we test is to have early awareness of getting sick and then protecting those around us from getting COVID-19. Now, there's a lot of unknowns still, right? We don't know folks who are immunocompromised or unvaccinated, how they fare with the current variant. We also don't know the impact of long COVID, which could potentially be substantial at a societal level if individuals cannot return back to the workforce.
Bhakti, what I've heard from a lot of people is they compare COVID to the flu. Well, off of your number, let's say it's 500,000, 460 deaths, 500 deaths, 460 deaths per day. Let's say it's 165,000 deaths from COVID in the next year versus about 50,000 from the flu. Do you suggest that we can say all clear because that 165 number is going to come down and be flu-like?
It's not about absolute deaths. It's about impact on society. So when COVID surges have happened, they've crippled the health system, which means people can't get routine surgeries, they can't get their cancer treatments, they can't go to the hospital if they have a heart attack. So when an infection cripples society and we cannot manage with it, then it's not endemic. Right now, we are coping with it, and so it can be compared to the flu and cold because there's test and treat centers, there's vaccinations, there's rapid diagnosis available. So it is manageable within our societal health systems framework.
Doctor, wonderful to get your thoughts, as always. Dr. Bhakti Hansati there of Johns Hopkins University. A lot for us to stay on top of, including Netflix, which is down by 27%. We've heard from Michael Nathanson and Moffett-Nathanson, and here's a note, Tom. Putting it all together, we have witnessed the company go from growth darling to growth purgatory in an instant. Yet the question from here is whether the company has gotten cheap enough for new buyers to step in. Their view, Tom, we would argue, not yet.
Well, this is Craig Moffett and Michael Nathanson, and it's a lonely crowd. John, on the break, you and I were reviewing the ANR screen of the Bloomberg terminal, which shows the hope that's still out there. There's a growthiness to the adjusted price targets of Netflix. How do you construct that growthiness this morning?
There are cuts across the board from the south side.
Yeah.
What's intriguing to me is that every single call that I'm looking at right now says $300 price target. Deutsche Bank cutting their call on Netflix to $300 from $465. We've got Stifel price target goes to $300. I've got Wells Fargo price target, the same thing. I'm going to go through some of this, Tom, just to make sure that this hasn't been automated incorrectly. But it seems to me that 300 is the new round number for a lot of people on the south side, Tom.
Yeah, okay, I'll say it's 300. I don't know. I guess it's about this advertising revenue, blah, blah, blah. What do? Raise the rates of the monthly Netflix thing?
Can they do that, Tom?
I don't know.
I mean, that's the question, is it? If people are cutting because of inflation,
Lisa?
I think what they've got to do is something
Your kids
about the
are glued.
sharing.
Lisa, your kids are glued to Netflix.
Really? Are they? Is that what they're doing when I'm not home? Honestly, I think that what they're going to try to say is that it's going to become a cash flow story and not a growth story. And John, to your point earlier, when can you switch to that, given the fact that you are looking at trying to capture some of those other subscribers?
The sharing is a massive, massive problem. I keep going back to this note that we got, the shareholder letter, and they give you the number. In addition to our 222 million paying households, we estimate that Netflix is being shared with over 100 million additional households. They acknowledge that's not a new story. They say that in the letter, but it becomes a new problem if you can't find growth. And Lisa, they can't find growth.
And this, to me, is really what's underscoring some of the comments about them doing a 180 with respect to their strategy. They had said this wasn't that big of a deal. They had said they could raise prices without losing too many subscribers. They had said they were not going to turn to advertising. They have flipped all of those things on their heads, John.
Final word, TK.
I just, Vet Bill's been using my subscription for
it's
years.
An important final word.
Are you telling me that everybody in the house has to get their own subscription?
Hey,
that's not going to flow.
I mean, let's see what they do. Not in the household, but perhaps if you're sharing it with one of the kids in another state, Tom. Maybe
well, there's a lot of that going on.
Exactly. Maybe they might have to get that.
I don't even know who's on my subscription. There's so many people.
Futures up a 10th on the S&P from New York. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
of investors are bracing themselves ahead of this big Fed move.
To what extent does consumption start to decelerate or at least grow at a less strong pace?
Part of what the Fed needs to do is tighten financial conditions, and they haven't really done that too much yet.
I think it's undoubted that we are seeing a slowdown in economic activity and the Fed pressing hard on the brakes.
At some point, the Fed's going to make a judgment call between accepting a recession and forcing us into one or just embracing stagflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures just about positive on the S&P. Netflix, Tom, down by 27%.
It's not only just down, it's the way it's down, John. It has not found a bid under any terms as a sell side readjusts and recalibrate here. We're down 27%, maybe 28% moments ago to a 252 level. This is a stock in chaos, John. We could talk about it all hour. We're not going to do that. But boy, what a lesson and what a structural shift for the industry.
Moffett-Nathanson asking the right question this morning, Tom. Has it gotten cheap enough for the buyers to step in? They argue not yet. Their price target's 245. I have to say, we're not far away, are we? 250, 331. Their previous price target, 350. The previous close, 348.
It's a movable feast here, John. And again, as I did with Alex Webb in the last hour, I'm going to go to what the others do that don't have the Netflix power. What does Paramount Plus do this morning?
And what is the price of content now, Bramo, given that you've got a big content buyer turning around and saying, we don't see the growth?
Yeah, are we basically seeing the death of content is king? Remember when everyone was saying that? It's all about buying the right content and then, you know, the sky is your limit. Have we seen a shift in that? I keep wondering how much is this a specific story to Netflix and the reopening trade, and how much is this a representation of how inflation can cause consumers to cut back on other expenses in their households?
I keep wondering a question we ponder often around Netflix earnings. The divide between the South side and the company. Tom, how do we get to a situation where they go through a quarter, they know the street's at positive 2.5 million, they're at negative 200K, and we don't get some kind of profit warning from the company? How does that come about? I don't understand that.
So you're going to get me in the Bloomberg
and we weren't just at
timeout here,
2.5 million for the last quarter. We were at 2.5 million positive for the current quarter. And it sounds like there's a 4.5 million spread between where the market was and where this company is.
You're going to kill me on this, John.
Say it.
Arrogance.
Is this going to fix it? Does negative 27% in a single day fix that arrogance?
This is cultural. If a ball-bearing company in Ohio did this, John, they would be hammered.
Well, they're getting hammered right now, Tom.
Well, the price is getting hammered, but I'm talking about at the board level, at the legal level as well. These people think they have a different playbook.
You got something to say to Reed Hastings personally? Do you want to elaborate?
I don't want to make it a personal thing. I think it is an arrogance of West Coast technology. I give Apple, Apple's got the luxury of they mint money, but, I'm going to defer to Michael Nathanson. Pachter at Wedbush has been brilliant on this. Dan Ives tweet out this morning.
Yeah.
Do we have the Ives tweet yet? Our control room is buried here with News 4. Chris, get up that tweet right now. This is Dan Ives away from Netflix. His guy has hit a home run out of left field on caution on Netflix. And Dan Ives here, John, this tech EPS is going to be haves and have-nots. He goes on to parse cloud from what we see. I love this. While work from home, COVID growth poster child stories will fade.
Including Netflix and including Zoom, etc. We're going to return to this story through the morning. The stock is down by more than 27%. I knew you were going to go.
I may not even be. You're just killing me.
You might be allowed back in the next segment. I don't know if Reed's going to make a call. Futures on the S&P unchanged. On the Nasdaq, we're slightly negative by 0.2%. Tons to talk about in the bond market too. Very briefly, a positive real yield. On a nominal 10-year yield, we're down 7 basis points to 286.28. In the FX market, the euro slightly stronger, up 0.6%. Euro dollar to 108.56. And Lisa, July, a rate hike from the ECB?
Yeah, that's what one governing member is saying right now, with possibly another one to follow later in the year because of how aggressive inflation has been. We'll get a sense of whether some of the hawkish talk actually is making any difference. Today at 10 a.m., U.S. March existing home sales come out. There is an expectation of an ongoing deceleration in the number of houses sold. People are less willing to go in and continue to bid up the prices simply because mortgage rates are the highest, going back to 2011 at a 5% level. But are we going to see that deceleration in momentum? We did not see that yesterday. Housing starts surprised to the upside, coming in at the fastest pace going back to 2006. How much has the Fed really continued to fall behind, given the fact that they haven't come through with that 50 basis point rate hike, and they haven't come through with even curtailing the balance sheet as quickly as many people have said that they should? Today, we get a slew of Fed speakers ahead of that quiet period and ahead of Jay Powell. Tomorrow, we hear San Francisco Fed President Mary Daly at 10:30 a.m., as well as Chicago Fed President Charlie Evans at 11:30 a.m. I want to hear what they have to say, in particular, Charlie Evans talking about how he does not see rates going to 3.5%. As we heard from others, but perhaps 2.25 or 2.50 by the end of this year. How much do we get edification of a potential consumer slowdown in the beige book that Tom Keene scrutinizes that will come out at 2 p.m. And after market, the earnings parade does continue. Tesla, the latest up. Interesting to hear what they have to say, John, about their China production, as well as, of course, Elon Musk's indications around Twitter.
Yes, we need a read around Shanghai in a big way.
Yeah.
Ramo, thank you, as always. Let's kick off the conversation in the bond market. For the first time since 2020, we had a positive real yield on a 10-year Treasury this morning, a little bit earlier today. Katie Kaminsky joins us now, Chief Research Strategist at Alpha Simplex. Katie, let's start there. How much of a game changer that is for this market worldwide?
Well, it means we're moving in sort of an interesting direction. And I'd say that the question is just going to be what is the headwind that could create longer term, but it's still relatively small. So I think for us, it's more sort of the difference between how high inflation is and sort of nominal rates. And then is that eventually going to push even farther for real rates? So we're kind of watching this closely, but it is still very, very far apart is what I would say.
Catherine, good morning. Trend following with Managed Futures was a Bible of years ago on what to do with commodities and trend. I'm thinking all Monroe Trout down in Bermuda this morning. Catherine, you're truly one of the experts on this as a disciple of Andrew Lowe. To cut to the chase, have commodities restructured now where they are truly trend able for Managed Futures?
Yes. I mean, what's so fascinating about trend following is that we follow what the market is doing as opposed to what it should do. And it's particularly these moments right now where we feel like the market should do this. Things should get better. Inflation should dissipate, that we actually start to see tremendous trends be quite profitable in these markets. So we've actually seen one of the most interesting short bond trends as a trend follower in decades this year, as well as commodities has continued to move. But I will tell you, our signals have dissipated some in commodities just with recent turbulence.
Catherine, given the fact that we've gotten so much uncertainty and so much volatility, do some of these trend-following strategies still work? Do your models still function the way that you expected they would?
Yes, in the sense that we build models that are attempting to measure all these factors. So as volatility and uncertainty enters the markets, we adjust our positions, and we also are trying to measure where and how much signals we have in different markets. What's been so fascinating is we've had zero signal in equity markets this year. And that is very consistent with this idea that it's very much either right or left, either we recover or we have a very challenging recession, but it's very unclear at this point.
Yeah,
so I think
I don't mean to interrupt, but I think this is so important. And as you know, the whole thing was built off Sun Microsystems Spark stations until the Bloomberg terminal showed up. Can you do trend-based analysis? Let's go back to Wells Wilder in 1978. Can you do trend-based analysis now, given what the central banks have dealt you?
That is a good question. I get that one a lot. And the point is that central banks just create different trends. This year, they've created a fantastic trend for us because they have sat around for a year saying transitory, and now this year have telegraphed a very clear rising rate environment. That has caused one of the most spectacular long trends in yields that we've seen in decades. And so what we see is that trends change over time, and they're just a function of what that environment is. Our job is really to move with things that are moving as markets move, especially when people don't like it.
Katie Kaminsky, as always, fantastic to catch up with you of Alpha Simplex on this bond market, commodities as well. Speaking of commodities, a little bit later this morning, in about 30 minutes from now, we'll catch up with Christian Manick at JP Morgan.
Yeah.
They've got some big calls over there, TK. 125 on Brent for 2022.
Wow.
150 for 2023.
Are we going to get the EU oil cut off?
And if we
from
get
Russia?
that, what does it mean?
Wow.
And also, Tom, what character? Let's say we get a ban, what does that ban actually look like? Immediate, all at once, absolute, or phased in over time with caps?
It's got to be
actually
based
look
over
like?
time. It's got to be based over time.
And if it is, does it make a big difference? Because in the meantime, you'd imagine you could reroute.
One of the biggest
some of that crude
mistakes
to
on
other
radio,
places.
I got a Marshallian cross going on radio. John, never forget how tight this cross is in the oil market. And the answer is, even if they institute over time, Javier Blas is going to tell us it's going to be disruptive to the market.
Brent crude, Lisa, 108.17.
I do wonder about the oil-gas divergence, though, because gas is really the main product that a lot of Europe relies on from Russia. How much does that end up sort of being carved out in ways that insulate the European economy for a bit longer as well?
We've learned they're not going to touch it.
Yeah.
Haven't we?
That's basically,
everything we've seen.
And that's a signal from the market where you've seen prices come back down dramatically, because it seems like that's the consensus right now. They're not going to go
whip
there.
through this market just briefly, not just equities and Netflix, which is down about 27%, but we need to talk about this bond market too. Your 10-year Treasury approached 3%, backed off a bit. It's down by 7 basis points today at 286. Let's call it 287 now. In Japan, they are protecting this upper band of something like 25 basis points. So you've got the global bond market selling off, Tom. The BOJ trying to restrict a 10-year yield to 0.25%. And the Japanese yen over the last month just really taking it on the chin.
You already got me in trouble in the last hour, John. You're doing it 2 hours in a row here. I'm just going to suggest watch yen. Matthew Hornbach at Morgan Stanley says weakness to 130 is feasible.
I just want to get Governor Kuroda on line 2, Reed Hastings on line
please.
1.
Yeah.
TK,
We can do that.
Some people who want to talk to you.
Qantas can do that.
Futures unchanged on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. Russia is calling this the second phase of the war in Ukraine. Early indications are that it could be better for Russia than the first. Russian forces are threatening to encircle an area at the top of the eastern front that holds as much as 40% of Ukrainian troops in the region. The Russian ground assault has been combined with a massive air and artillery bombardment. China says it will keep boosting strategic ties with Russia. A senior Chinese diplomat indicates the relationship remains solid despite growing concerns over allegations of war crimes in the invasion of Ukraine. Trade between China and Russia rose in the first quarter, but much of that was before the war began. And the Biden administration hasn't figured out how to respond to a federal judge striking down the mask requirement for plane and train travel. The White House and various agencies were struggling to coordinate a legal strategy. More than a day later, the mask mandate had been losing support, even among some Democrats in Congress, well before that court ruling. And Netflix is throwing out its old rules after losing customers for the first time in a decade. The streaming leader will introduce a cheaper ad-supported option for subscribers in the next couple of years. It also will crack down on people sharing their passwords. Netflix projects it will lose 2 million customers in the current quarter. Shares plummeting again today. Global news 24 hours a day on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
I'm a bigger fan of consumer choice. And allowing consumers who would like to have a lower price and are advertising tolerant get what they want makes a lot of sense. So that's something we're looking at now. We're trying to figure out over the next year or two.
That was a tough call. Reed Hastings, the co-CEO of Netflix, with that stock getting absolutely hammered. From New York City this morning, good morning. Equity futures on the S&P just about positive. On the NASDAQ 100, negative 0.2%. Only one stock to talk about, so let's do it right now. Netflix is down by 27%. We were looking for something close to 2.5 million subscribers. We got negative 200K. For this quarter, we were looking for something close to 2.5 million subscribers in addition. And Tom, we've got a projection from this company of negative 2 million. Tom, that is a massive spread between where the street was and what this company's projecting.
Any number of people, John, this morning taking a victory lap. We mentioned Pachter over at Wedbush, and of course, Michael Nathanson, who I believe may join us later this morning. Right now, somebody who absolutely crushed his call, neutral forever, like back 2.5 years with a recent underperform, but flat out, he has basically never said, buy Netflix. Timothy Nolan joins us now, legendary at Bear Stearns years ago in publishing and out of London with J.P. Morgan. He is with Macquarie, the Australian shop. Tim Nolan, what did you see in October 2019 where you said run?
Well, we did have a buy rating on Netflix going into the time when the streaming wars really got underway. And we downgraded Netflix from an outperform to a neutral around the time that Disney Plus was launching. And the rationale was very simple, and I think that's coming to bear very clearly right now, which is that more competition from major content houses going direct to consumer will simply keep the pressure on Netflix, will take away from their ability to add subs as aggressively as they had been doing for years and years and years, and will raise the pressure on content costs. And we've seen all of that come to bear, very clearly, especially in the last 2 quarters now. Last night's results from Netflix were really pretty much the same thing as the quarter before, with a sub miss, a guidance figure for the next quarter, which was a lot lower than the street expected. And again, a comment that operating margins will be, now they're saying flat in 2023 after having cut that guidance in for 2022.
Tim, your words. We think Netflix looks like dead money for now. Growth the next 2 years looks more like that of a traditional media company. In addition to that, as you point out, and you're right too, the big news is this concession that they've got to pursue an ad-supported offering. How much of a game changer is that, Tim?
It's huge. I would say unexpected in some ways. I did not think that Netflix would necessarily come out with an ad-supported business model plan this soon. I think maybe it wasn't surprising that they would eventually do it. And actually, they are still saying it'll be a year or two probably until they can get it, figured out and rolled out. So that's why I say it's dead money. There are good upside opportunities from this, but it's just going to take quite a while, really, to get it all going. We've done some work on some of the peers in the direct-to-consumer streaming space, some of the content owners like Disney with Disney Plus and like now Warner Brothers Discovery, launching Discovery Plus a little while ago. They have ad-supported options that, at least in Discovery's case, have led to about double the ARPU, and which also, of course, attract more subscribers. So it's a nice setup, actually, for both sides. The consumer can be attracted to sign on to the service. The provider, in this case, Netflix, can actually make more money given how strong the advertising technology is today to be able to serve targeted ads, high-value targeted ads, and therefore drive even a higher ARPU for the service.
Yeah, but Tim, there is a question of whether this really is an acknowledgement, not only by Netflix, but the streaming industry at large, that this is no longer a growth area. Do you think that Netflix is a specific story, or do you expect the other streaming services to follow with advertising and, frankly, with lowered projections for subscriber?
Well, I think streaming is a growth business still, for sure, and particularly internationally outside the U.S. There's a lot of runway to grow. Netflix has a huge head start, and they've got a lot of progress, I think, to make. I think, though, in the case of a broader media company, streaming within the traditional business makes the broader business look not so exciting. In Netflix's case, it's almost like it's being transitioning, from an internet company, internet stock, to a media company, a media stock. And they've spoken about this, quite publicly before, where they aim to provide the type of metrics that investors have looked for in media companies in the past. Strong revenue growth, strong and high margins. And Netflix will have that. The problem is it got so high and it moved so far over the previous, 10 years or so that now, everything is catching up to it with all this competition coming. Now they're trying to hold on to 10% revenue growth in the future, which for a traditional media company in the good old days was pretty good, and get margins back up again, moving into 2024.
Hey, Tim, just quickly, we touched on this at the top of the hour. Tom and I went back and forth on this. What do you make of the communication from the C-suite to allow the street to run with an estimate of close to 2.5 million subs when they knew what was happening inside the business? And the same again for this quarter too, to have the street somewhere at 2.5 million and they're projected 2 million. Tim, what do you make of the fact that they didn't get out ahead of this?
Well, a couple of things. By my count, Netflix has now missed its sub guidance. I think it's 4 out of the last 7 quarters. They always used to hit it, right on the head, or of course beat that number for many, many, many years. Clearly, they didn't expect the number to come in this low, or they wouldn't have given that guidance number 3 months ago. That said, I don't think Netflix is as focused on the raw sub number as the street is. And actually, I think that's the right approach. So they talk about, the ARPU that they can generate. They talk about, the user engagement. They talk about revenues. And I've said this for a long, long time. The raw sub number is important, but really it's about the revenues and earnings ultimately. And as Netflix becomes more and more of a, let's call it a media type of a company, that is what matters. So I think their focus on driving engagement, their effort now to convert some of those evidently 100 million, free ride providing users of the service to become paying subs, the effort to get a lower price service, to get more subscribers on, all of that is designed, yes, to generate subs, but then to generate more revenue growth and ultimately more profitability. But I think that's really more the focus than the sub number itself.
Tim, super smart. Great to catch up. You reiterate you underperform, and it's good to catch up with you, sir. Tim Nolan there from Macquarie. Tom, that stock is down by just under 27%, 26.8% right now.
For those that remember the wonderful experiment of Verizon and AT&T becoming LA media moguls, Hollywood media moguls, John, I think what's interesting here with Mr. Nolan Ford is exactly how does Warner Discovery find synergies, and at what rate do they find synergies?
Got a call on Zaslav, Tom.
Yeah.
10 seconds. What is your call?
I don't have a call on Zaslav yet. I think it's too early. What I'm saying is they got to cut a lot of costs fast.
From New York City, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City for our audience worldwide on TV and radio. This is Bloomberg Surveillance, and here's your price action. Remain's going to run you through the news with Netflix. That stock is down and down hard by about 27%. Equity futures are doing okay on the S&P, positive 0.03% after the close. We'll hear from United. We will hear from Tesla as well. On the Nasdaq, we're down a little more than 1/10%. Tons to talk about in the bond market, not just in the Treasury market, but worldwide. So let's talk about a 10-year Treasury, a 10-year bond, and a 10-year JGB, and start with the Treasury market. B of A believes now is the right time to get long. They target 225 on 10s right now. We're at 286.48. They believe inflation will peak, has peaked already for the year, will slowly fade into 2023. As that fades, the inflation panic will recede, and they believe the long end and the yields can decline. Their view. Two views take a market. I'm sure many of you are on the other side of that trade. Good luck to you. In the bond market for Germany, that's not snarky, I'm just saying that's how it works. In the German government bond market, we are facing the prospect of rate hikes from the ECB. There was a governing council member from Latvia on the ECB this morning speaking to Bloomberg, teeing up the potential, the possibility for a rate hike in July. Again, pick your poison, which side of the trade you want to be on. In Japan, they're just trying to rig the market. Let's put it this way. They've got an upper ceiling on where they want the 10-year yield to be on a Japanese 10-year, and it's 25 basis points, and we're right there right now. How sustainable, Tom, is that policy, given what's happening in the Treasury market, given what's happening in the German government bond market as well?
It is not, and it has never been. It has been a 5, 6, 7-year fiction waiting for the rest of the world to adjust. The rest of the world is adjusting right now.
And as Treasury yields have broken out in a bigger way over the last month, as bond yields have done the same thing, Japan has to do more and more work to keep it at 25 basis points. As they do that, you push it through the FX market, a weaker Japanese yen. Add in the fact that we've also got this one, Bramo, a positive real yield in America for the first time on a 10-year, going all the way back to 2020. That has been the story for us overnight.
And the question, I think, with that is, has it truly been priced into equity markets that we're going to have positive yields going forward, if that is really the case?
Which side of the trade is Bramo on? You can all guess for yourselves. That's the cross-asset price action. Let's get you some single names and say good morning to Romain Bostic. Good morning, Romain.
Hey, good morning, John. You've been talking about it all morning here. Of course, a decade-long streak of growth after growth after growth, quarter after quarter, coming to an end for Netflix. A loss of 200,000 subscribers on a net basis in Q1, projecting a loss of 2 million more for Q2. And the tone really further out into 2022 and into 2023 really wasn't any better, despite the fact they didn't actually give hard numbers. A lot of concern now as to what's ailing Netflix, whether that's something broader for the industry writ large here. Disney, Roku, Fubo TV, all down here in the pre-market. Of course, Netflix taking the brunt of the selling here, down a whopping 27%. Remember, that's going to surpass the 22-23% drop that we saw after its earnings report in January when it guided lower. That's going to surpass that 25% drop we saw all the way back in 2012 when it came out. Was sort of a big inflection point there when a lot of people were doubting the growth story then. Remember, Reed Hastings was able to buck that trend and managed to win back over a lot of analysts on the street, as well as a lot of investors. That stock over that decade-long period was one of the 10 best performing stocks in the NASDAQ 100. If you factor in the pre-market move today, this is going to be the worst performer in the NASDAQ 100 and the S&P 500 to start the year. We should point out, you had Tim Nolan on, I think, just a little while ago over at Macquarie. We should point out now, this is a stock that had 37 buy ratings at the start of the year. That's now dropped to about 21. Hold ratings outnumbering buy ratings on Netflix right now. Flip it up, that was a drama, of course, that we had yesterday after the bell, guys. A drama that we're going to have probably tonight after the bell is going to center around Elon Musk and Tesla. Those earnings are coming out. The numbers themselves pretty much immaterial. It's really about sort of what Elon Musk has to say about the future of the factory, the Giga, the Cybertruck, and all these other sort of grand ambitions he has. And of course, there will be a lot of questions about his involvement in Tesla. IBM shares one of the bright spots here on the day. They did report earnings. And Lululemon coming out with their sort of 5-year plan. They have a big analyst day coming up a little bit later. We've already gotten the news. Basically, they're going to refocus, John, on menswear, trying to get you out of that Burberry and into maybe something.
Here we go. Romain, what do you think about this?
Yeah.
You know the trend on Wall Street.
Yeah.
A certain group of individuals are wearing Lulu pants to go to work. I've got views on it. Have you?
Yeah, I'm neutral on it, John. I think everyone should just be them. Be free, John.
Is that what in the Patagonia sweater as well?
Patagonia sweater, Lululemon pants.
The Midtown uniform.
I bought my first Can I just say I bought my first Lululemon pants during the pandemic.
And how's that working out?
They're quite comfortable. I haven't worn them to work quite yet.
Would you wear that on the clothes?
On the clothes.
The full Midtown uniform, the Lulu pants with the Patagonia vest.
I'm not sure the guy on the side of the building, he would approve of that. that. But
You
we'll
think he
see.
might have problems with that?
He might.
Romain,
I'll
thank you.
chat with him. Yeah.
Looking forward to it. Romain might debut the Lulu pants a little bit later on the close with the Caroline Hyde and Taylor Riggs. Romain, thank you. TK, you could work that. I could see that. TK with the Lulu pants, the Patagonia vest and a bow tie. Think that works, Tom? No? Not going with it?
Well, he does yoga.
He does yoga.
Yeah,
He does. I've
with
actually
that
seen
belt.
Tom do yoga.
Really?
They do family yoga.
Oh, dear Lord. He's
They do
doing
family yoga in the
that's
gym.
right.
I've seen it.
Is
And he makes the breathing noises and everything.
Is he falling off the chair? Tom, come back to us.
Tom, that is a worrying face.
Please come back to us.
That looks kind of scary.
Yeah, it's scary. Okay. I don't get it, John. I don't get the new
I don't
uniform.
get it. But my advice to newly minted graduates in whatever banking scheme they're in, dress properly. That's it.
You've gotten me so much trouble today, John.
No, I
I'm
know
just
you've got
going
things to
silent.
say
I'm
too
going radio
on that.
silent
I hate
here.
the
Good morning
Midtown
on
uniform.
Bloomberg Radio, Bloomberg Television as well. For someone that writes a wonderful research note, James Bianco joins us now. Jim Bianco, president and founder of Bianco Research. Jim, I love your chart where you say, would everybody stand up, wake up, and understand that weak Japanese yen matters to American investors? Why?
The Japanese are the largest owner of treasuries, largest country owner of treasury securities. They own more than China does right now, $1.3 trillion. As they try to hold the Japanese government bond yield at 25 basis points, when every other yield in the world is going up, they're increasing their spread to the rest of the world and they're making their currency unattractive. If they keep doing it and the yen is down 12% in a month, it's going to have big implications for their financial markets and economy, and they're a major country, and we're all going to feel it.
Jim, what's so important here, and this begins our coverage, I'm going to say 90 days ago of David Fokerts-Landau at Deutsche Bank, making real clear his number one concern is devaluation of currencies against an ever stronger, resilient dollar. At what point does yen tip into some form of devaluation panic where Japan has to act?
They're very close to it right now. I mean, as I said, they've moved up 12% or lost 12% of their value in the last month. They approached 130 on the yen overnight. And I guess the BOJ's got a difficult question they got to answer. They can continue to hold their yield curve control peg at 25 basis points in the 10-year yield and let the currency go, or they can let the peg go and defend the currency. But they can't do both at the same time. And I think we're getting close to the point where they're going to have to start thinking more about their currency than they are about their yield curve peg.
Jim, do you think that people ought to be paying more attention to the consequence of Japanese monetary policy on the U.S. Treasury market, considering the fact that the Japanese investor owns more treasuries than even China, more than any other external investor?
Yeah, they should, because as their currency goes and as their interest rates go, that's going to maintain its relative attractiveness of the U.S. Treasury market. Should they let the peg go and interest rates rise a lot in Japan, and we saw that last fall when Australia abandoned yield curve control and it rose a lot of those investors that are buying Treasury securities, again, 1.3 trillion, might find attractive yields in Japan for the first time in a generation. And that will lessen the demand for treasuries at a time that the Fed is leaving the market and other people that are saying that the treasury market or interest rates or the bond market are uninvestable because of the higher rates. You're going to just lose another major player and you're just going to compound the problems in the bond market.
What does that translate into in terms of how much higher yields can go?
You know, when you see yields do what they've done so far this year, and on a total return basis, when you factor in the yield and the price, this has been the worst year in the history of statistics. The Bloomberg Global Aggregate Index goes back to the mid-70s. It's down 10% for the year. That is an extraordinarily large move for the bond market, and it's only the middle of April. As we continue to see this happen, you have to start to worry, and I am, that there's going to be knock-on effects or unintended consequences. The bond market, the banking system, the financial system is not really designed to have the entire bond market lose 10% of its value in 4 months. Every other time we've seen this, we've always run into problems. Now, I'm not saying we have problems now, and it might be a while off. And we've also seen when you see extraordinary moves like this, I hate to say it, but they continue to go until something breaks. That's what happened in 94. That's what happened in 99. That's what happened in 87, when you had huge rises in yield They kept going and going, and everybody kept saying it's over, and it wasn't over until something broke. And that's what I'm afraid of now, because this move is getting into that kind of territory.
Hey, Jim, conversations with you are always valuable. We've got about 60 seconds left. When you say something might break, what have you got in mind at the moment?
Well, either that the stock market wakes up to higher interest rates a la 87. I'm not talking about a crash. I'm talking about that they just recognize that higher rates are bad, or that higher rates that translate into mortgages and borrowing costs really shut the economy down fast, or some kind of a plumbing problem like we saw in September of 2019 with the repo market. This stuff is very complicated, and when you see extraordinary moves like this, you never know what kind of impact they're going to have on it.
Jim, super smart. As always, let's catch up soon. Jim Bianco there of Bianco Research. TK, off the back of a big move year to date on treasuries and bonds and others too.
Well, the yield market moving. George Saravello's publishing moments ago off their week of Easter research. This at Deutsche Bank. And, you know, they're fractious like Morgan Stanley. I'm not sure they're all on the same page, but he makes clear in a wonderful chart, John, the set of super weak currencies right now. No surprise. Turkish lira leads the way, Russian ruble, not a surprise there. But the big dog in the room is Japanese yen is one of those weak currencies, and that speaks to the manipulation of the government in Japan.
That's the story with the Japanese yen coming up. We'll get to the story in the commodity market. It brings me great pleasure. I'm very happy to say we've got a fantastic lineup for you today, including Christian Malik of JP Morgan on why they think crude can get to 150 next year.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned a small but growing number of senior Kremlin insiders are quietly questioning Vladimir Putin's decision to go to war. They believe the invasion was a catastrophic mistake that will set the country back for years. So far, these people see no chance the Russian president will change course and no prospect of any challenge to him at home. In Shanghai, businesses from car makers to supermarkets are gradually resuming operations in the midst of that massive lockdown. Many factories are able to restart using a closed-loop system. That's where staff work and live on site and undergo regular testing. Health officials say that 2/3 of Shanghai's 25 million residents are still locked down. And Elon Musk has given fresh fuel to speculation he would launch a tender offer for Twitter shares. The billionaire tweeted a message with a blank space followed by the phrase, "is the night." The missing word could be tender, as in the book by F. Scott Fitzgerald, Twitter's board has yet to make a formal response to Musk's $43 billion takeover proposal, but it has adopted a poison pill provision to defend against it. Just Eat Takeaway is considering a partial or full sale of its Grubhub business. The Dutch-based company says it's considering strategic options for its U.S. unit less than a year after buying it for $7.3 billion. That highlights just how the end of the pandemic has turned the food delivery industry from a hot property into a struggling sector. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Probably we are going beyond neutral. I mean, that's my expectation when I see that taking out special factors, I'm still left with 3 to 3.5% inflation. That's not what we want. If the 2.5% inflation rate, I think we have more things to ponder there.
Let's see how long it takes to get there. That was Charles Evans, the Chicago Fed president from New York City this morning. Good morning. Your equity market's shaping up as follows on the S&P 500, up 0.1% on the NASDAQ 100, down almost 0.1%, and down a whole lot more as Netflix. It's negative 27% after a wild miss yesterday and projecting more pain, even more pain, a lot more pain for this quarter as well. Look out May 11th. That's how long you've got to wait for the Walt Disney Company, Tom, to see how Disney Plus perform.
Oh, yeah.
It's a few weeks away.
I'm completely focused on the Warner Discovery path here and what they do with 56% debt, whatever the debt number is on the Bloomberg screen right now. I take the point on Disney, John, and the rest of them, but wow, Warner Discovery, the merger of, what is it, John, 47 cable networks?
And CNN Plus and what's going to happen with that, Tom, and
yeah.
What people
I got to take it because of Animal Planet. Vet Bill and Kennel Fear watching Animal Planet.
Watching Animal
every
Planet.
night, every single.
How much is that costing you?
It's a fortune. I got like 7 things I'm doing.
Tom, I'm with you. It's too much. I've got Italian football on Paramount. I've got to buy Peacock to watch the Premier League, as well as Hulu with ESPN for Formula One. It's getting messy.
Okay. This is important, folks. On December 31st, 2022, you're going to remember this conversation. It is 100 pages that James Dimon will read at JP Morgan, and it is an exceptionally brave document on energy. Christian Malik joins us now, global energy strategist, who with Marco, as he's literally called within Global Wall Street, and also Natasha Kaneva, has written an absolute mandate for the superiority and continuation of hydrocarbons. It is without question the most anti-woke document I've seen in years on Wall Street. How is the climate change crew, Christian, going to react to your pro-energy, pro-oil demand call?
Yeah, it's interesting because when we set about doing this report, we sort of made sure that we were absolutely agnostic of all fuels and think about energy rather than in barrels or megawatts, but rather joules, so the calorific value of energy. And when we built out our energy demand outlook to 2030 and then did the same for supply, again, looking across all fuels, and arguably not all fuels are made equal, we made sure that we started with the clean energy. So we basically built out our view on renewables using our fantastic utilities team. And as we went through the use and application of these fuels, and then sort of work backwards by sort of end use, we then sort of found ourselves back in the oil and gas, the fossil fuel category, and had to do the maths in terms of, well, if we've got a deficit of around 80 exajoules, which is 1 to the 18 joules, how do we solve for that over the medium term? And by doing that work, we sort of ended up coming back to filling that through investment in oil, gas, as a sort of a bridging fuel in order to make sure that we can deliver this deficit, otherwise very high oil prices.
You know, we're doing an exercise here in thermodynamics, folks. Christian and I are going to wade into entropy here in a moment, and there's gigajoules and petajoules and the rest of it. Lose the thermodynamics, Christian, and tell me where the desire is to invest capital for the rising oil demand that's the heart of your work.
Absolutely. In fact, I mean, the key takeaway, Tom, is energy demand growth will exceed energy supply growth by 20% by 2030. And the only way to fill that is by investing around $1.3 trillion. And by the way, that's not just producing the energy, that's also that includes delivering it, right? So what we found is that these two axes actually generating, which is through all the different fuels that we've looked at, as well as distributing it to the end consumer, to the end user, be industry. So the combination of those 2 points, $1.3 trillion by 2030, we have a lot of money to spend across all fuels. And right now, this deficit suggests to us that we're basically embarking on an energy super cycle across all forms of energy and elevated prices for some time.
Well, Christian, that's exactly where I wanted to go. I mean, this statistic from your report stood out to me, that growth in a global energy supply is set to fall 20% below the growth in demand out to 2030. How high could prices go? And we're not just talking about due to the Russia-Ukraine issue. We're talking about on a sort of structural basis. Where do you see oil prices kind of hovering?
Yeah, it's right. In fact, you sort of have to assume that if we don't see that investment, prices will move higher for longer. And within that context, we've set about a long-term view for oil around $80, which is effectively the marginal cost to produce, to deliver and close that deficit in the medium term. And it's going to need all hands on deck, Lisa. It's going to need OPEC, it's going to need the majors, the shale companies to invest in order to meet that incremental demand. And one point we've made is that oil is oil. It's non-fungible. You can't use solar panels to produce petrochemicals. So you've got to produce more oil for particular industries. And right now we're falling short. Similarly for gas prices and equally for renewable power prices, across the energy complex, we're seeing significant underinvestments. And not just that, I mean, it's sort of almost inverse. In fossil fuel, you've got a shortage of capital, but plenty of resource. In sort of the clean energy, you've got plenty of capital, but you've got a shortage of metals, supply chain constraints. So wherever you look, whether it's producing it or distributing it, there are constraints which could see overshoots. And those overshoots, as we know, we've talked about, come down to one thing, which is what's the global capacity or spare capacity of energy? Within oil, we're now down at 3% in terms of OPEC spare capacity in terms of total OPEC. And that, you know, when we talked in November, we talked about 5 to 7%. That was our view, and that was conservative. That would mean that we could see potential overshoots, a lot of volatility, which does sort of flow into what does this mean for social unrest? What does it mean for the implication on societies, which we've also looked at in the note.
Christian, I've got to get to a final point, and forgive me for asking the simplistic juvenile market question, but the best way to overweight this, through the commodity or through energy equities, which have ripped year to date?
the best way, we've got to distill it down to three themes. We want to be long oil, long renewables, long LNG. Within those three themes, we looked at the best equity ideas globally that offer a combination of valuation, cash returns, and outsized volume growth. And that volume comes back to one thing. It's no longer barrels or petawatts. It's essentially just joules of volume growth that meets this deficit. And when we look at those factors, we're down to companies like Shell, because it's long LNG, Cheniere, which has got great exposure, also RWE in order to enjoy sort of the deficits in renewable energy that we're going to be seeing, and companies like Exxon, who do have the outsized oil leverage and cash return. But I'd say one thing also that's really important,
just quickly,
which is that they've got to do this while lowering their carbon emissions. So scope 1, 2, and 3 will be quite an important factor in how these companies evolve and re-rate.
Christian, super smart. Congrats to you and the team for putting this out. A fantastic read for us all. Christian Malik there of JP Morgan. TK with some big energy calls there, not just for the commodity, for the stocks as well.
I think we've led with a lot of coverage of climate change, the surveillance coverage, John, at the Paris Accords years ago with Robert Redford and others. This is an absolute mandate for oil, and James Dimon in his annual letter, buried in the letter, John, Jamie Dimon says oil is essential and critical.
What did you call this morning, Tom? The least woke note on Wall Street.
It's the least, I'm sorry, this note is a clarion call for global finance.
From New York City this morning, good morning, with Tom Keene, Lisa Abramovitz and Jonathan Ferro. TK might be back in the next hour.
It's 50-50.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
If inflation does start to roll over, some of that pressure is taken off the Fed.
We still need to see real rates rise a little bit, maybe another 25 basis points. That is disruptive for U.S. equities.
The Fed is much more hawkish than they've ever been.
The Fed's not doing enough. They're going to be tightening in an economy that is slowing, not accelerating, and that will make a soft landing a very difficult task.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. What are you doing? You're watching us, or you're watching Netflix South this morning, down to a 252 level. I mean, John, right now, a little bit of a bounce, and we're going to come down. We're going to retest that crater at negative 27%.
And Tom, my issue with this is they've done it twice now this year. Fool me once, fool me twice. I mean, look, we were down 22% after earnings in the last quarter, and here we are again doing the same thing, down 27%. This time, Tom, though, a letter to investors essentially saying this growth company is going X growth, and that's a big, big problem for this equity market.
What we do on Surveillance, the insight we can give you. Tim Nolan joining us from Macquarie, a genius. He never had a buy on it back 2.5 years as well. John, I love what Dan Ives said, away from his competency of Apple, and the rest was because it's going to be the haves and the have-nots this earnings season.
It's Tim Nolan over at Macquarie, Tom, basically said it's dead money for now. Growth over the next 2 years looks more like that of a traditional media company. And TK, I know that's where your focus is.
Well, the traditional media is going to be there, and I'm going to look at Warner Discovery and their work out of billions of dollars. Synergy is in order there right now. Lisa, help me with the synergy here for a Fed as we celebrate for, I think it was the time it took me to figure out my Netflix subscription, then the real yield actually went positive.
Well, and they should actually welcome this, right? I mean, we've been in an abnormally suppressed yield environment, so this isn't that unusual. The question is just how much higher does it have to go in order to be restrictive? Because we are hearing increasingly that they're looking for some sort of restrictive policy. And if they don't get that kind of policy in place, what happens to inflation, given the fact that inflation expectations over the longer term have continued to climb?
So how do you perceive in the credit market, Lisa, the path to a restrictive reality? Is it quarters or years?
In the credit market, it's a different story. I think people are looking in the very near term. Over the longer term, this is the key question. Can you do it slowly, or does the idea of inflation get entrenched in the population? Right. And you see sentiment start to drive ongoing and stickier inflation, and that, I think, is the fear. Are they going quickly enough? How long can they remain behind the curve?
I'll give you fear. Let's go out, Marissing and Weber. John, the German PPI number shows you ECB, they have to focus.
Yeah, and some governing council members are thinking about a move in July. If they're going to make that kind of move, Tom, then they need to do something about the sequencing with QE, because that's set to end in Q3. Do they accelerate that at their next meeting? We've got to wait for the outlook from them. For me, Tom, the outlook is on Japan at the moment. That's where my focus is. With a breakout in Treasury yields, a breakout in bond yields, the ECB set to follow the Fed in some fashion. I don't think in the same fashion, but in some fashion, Tom. And at the end of the day, can the Japanese and the Bank of Japan maintain a policy that caps interest rates on a 10-year, Tom, at 25 basis points? That's going to be very, very difficult to do.
Out on Bloomberg Digital, we'll continue this in this hour, but out on Bloomberg Digital, our conversation with Jim Bianco was piercing here about the reality of weak yen and what it means for all of America. 128 rounded up. We had a 129 roundup yesterday as well. John, let's do a data check. I'm just going to suggest Dow Futures up 124.
Thanks for that, TK. Equity futures up by about 0.4% on the S&P, on the Nasdaq up 0.5%. A nice lift to the equity market, a bit into the Treasury market, yields down by 7 basis points to 286.28. In the next hour at about 9:30 Eastern time, I'll get a view on the bond market for you from JP Morgan's Bob Michael. Bob likes credit here, Tom. He likes it a lot. and I'm looking forward to catching up with him to get the why.
Nice plug for the next hour.
Anytime, Tom. Every time you do Dow Futures, I'll just promo my other show.
It's great. Netflix back to a 252 level. Seriously, folks, a breakdown under 251.62 would be new intraday lows for Netflix. We'll continue to watch that. Right now, Victoria Fernandez joins us, Chief Market Strategist at Crossmark, and she has the jumble to piece together of what to do now. What's the first thing you look at each morning, Victoria, to try to frame a strategy?
Yeah, so right now, Tom, and by the way, I'm glad you made it back for this hour. I know you said it was 50-50. So we're glad to see you here.
You got a whole closet of Lululemon. Can you see me, Victoria, in Lululemon? I don't think so.
Yeah, me neither, but it's all good. We're looking at the yield curve, Tom, every morning. It's the first thing I want to see. And not just where the 10-year is and not just the U.S. yields, right? We're looking globally. We're looking at real yields. You guys have been talking all morning about where real yields are and how that flows into financial conditions more broadly, that we're just now starting to see financial conditions tighten. The Fed wants to see more of that. So we're watching those to see, is there progress there? Because I think if they start to see some progress, maybe it gives them a little bit more room not to do as many rate hikes, but we're not seeing it. We're not really seeing it in the dollar. The equity market is volatile. We're not seeing it in credit spreads, and so I think we have to really look and see where global yields are heading and what that yield curve looks like across the board.
Any reason to buy cyclical equities right here, Victoria, given the beating that they've had so far?
Yeah, I don't see why you can't be choosy, Jonathan, right? There's nothing wrong with being a picky stock buyer in this environment. Our outlook for the S&P is 4,500 for the end of the year. So we're close to that right now. That doesn't mean we don't think it's going to go above 4,500. We think there's going to be a lot of volatility this year. We've talked about that before. But you need to be choosy. So look at some cyclical names. I think that's okay. We like financials. We like Bank of America. Financials have been hit pretty hard. We like Visa. I think you can go in and find some names that will be opportunistic for your portfolio, but I don't think you just go all in on, cyclicals or all in on a particular sector.
So, Victoria, do you see value in Netflix right now?
That's a dangerous question. Value from a consumer, I think people probably still see at this point in time. From a stock perspective, that's going to be a little bit tougher. I know we own it in our covered call strategy, so I was talking to our portfolio manager on that strategy yesterday. Where are we positioned for calls? What does that look like for rolling that call over? It's going to be pretty difficult, down 27%. I'm going to really be watching to see when Disney earnings come out, what that streaming outlook looks like for them. It's probably going to be a tough road if you're looking at that for a pure reopening play that many people did.
Do you foresee more Netflixes out there as this earnings season progresses, considering the fact that people have such bifurcated views and are looking to punish certain areas with their bearishness while getting long areas that could possibly provide them income at a time of such high inflation?
Yeah, so, all during the pandemic, one of the things we told our clients was look a little bit further out, right? Don't just bet on these quick turnaround plays like a Zoom, like a Netflix, like a Peloton. And I think if people were putting all their eggs in those baskets, they're really going to get hurt here. They need to do their homework and do that bottom up work and make sure you've got strong balance sheets, you've got growing dividends for corporations. Profit margins are still holding pretty strong, and corporations, their largest issue right now is labor. So what are they going to do with this cash on their balance sheets? They're going to do CapEx. They're going to try to increase productivity and invest in tech. So I think you need to look at those types of companies.
Victoria, help me in the realities of Crossmark with the nonprofit tech area. It's been brutal. What do you say to clients that want to climb on board the next tech vogue where there isn't free cash flow, there isn't a sustained EBITDA?
Yeah, we don't like the nonprofit companies like that.
That's why I asked.
Where they should have profit and they don't, that's going to be a danger signal. You've got to look at those balance sheets and look at those cash flows, look at those debt ratios that they have. It's really important in how we pick companies. So if we're going to look at a tech name, we're looking more at the value component of tech right now, like an Intel, maybe a Cisco. VMware is a name that we're looking at, talking about CapEx that companies are going to do. VMware has had a large surge in in-house systems that people are trying to put in place to increase productivity. So I think those are the areas you probably want to watch.
I know John Lululemon loaded the boat there.
Is that what they did, Tom?
Yeah, they had to buy it.
Victoria, thank you, as always. Victoria Fernandez there of Crossmark. She's wonderful. Bloomberg Real Yield regular, Tom.
Welcome you to the Surveillance
He
Shopping
didn't even
Network.
quote the Dow.
John,
He didn't need to. I've got this one for you, Tom. David Focus-Lando from Deutsche Bank, the group chief economist, just published. Give me some time here to read out the conclusion. If central banks don't act soon and more aggressively than forecast, inflation expectations will likely move significantly higher, ultimately leading to an even more aggressive tightening and hence a deeper recession with a larger rise in unemployment. They conclude by saying the following: whilst there may be a temptation to let inflation drift at a higher level, we do not think the Fed would risk losing its hard-won credibility. Prepare for a hard landing ahead. And this has become the view of Deutsche Bank over the last couple of weeks as they look for a recession, Tom, out in the back end of 23 into 24 in the US.
So Matt Lazzetti leading that, and folks, the background here is Folkers-Landau with Dooley and Garber 20 years ago with really authentic, original research on capital flows. And John, all I got to say is Folkers-Landau has his radar up on the forced depreciation of currencies with a resilient dollar. When does that snap, as we heard from Jim Bianco before?
Elisa, it is the house view of Deutsche Bank. Prepare for a hard landing.
The issue for me is not whether there'll be a hard landing, it's when. And that seems to be the distinction for a large number of houses. We're going to get a recession at some point. Whether the Fed can really orchestrate this in a less deep recession seems to be more the call ahead.
Let's get through the price action. We need to talk about Netflix in just a moment. Once again, equity futures are doing okay on the S&P. A lift going into the opening bell. 1 hour and 20 minutes away. Futures up by 0.4%. On the Nasdaq 100, up almost 0.5%, up by 0.45. Yields come back a little bit, down about 7 basis points to 286.86. And Netflix, somewhere out there, getting absolutely hammered, down by 27.4% today, this morning, in a pre-market alone. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Russia is calling this the second phase of the war in Ukraine. Early indications are that it could better for Russia than the first. Russian forces are threatening to encircle an area at the top of the eastern front that holds as much as 40% of Ukrainian troops in the region. The Russian ground assault has been combined with a massive air and artillery bombardment. China says it will keep boosting strategic ties with Russia. A senior China diplomat indicates the relationship remains solid despite those growing concerns over allegations of war crimes in the invasion of Ukraine. Trade between China and Russia rose in the first quarter, but much of that was before the war began. The Biden administration hasn't figured out how to respond to a federal judge striking down the mask requirement for plane and train travel. The White House and various agencies were struggling to coordinate a legal strategy more than a day later. The mask mandate had been losing support, even amongst some Democrats in Congress, well before the court ruling. And Netflix is throwing out its old rules after losing customers for the first time in a decade. The streaming leader will introduce a cheaper ad-supported option for the subscribers in the next couple of years. It also will crack down on people sharing their passwords. Netflix projects it will lose 2 million customers in the current quarter, those shares plummeting today. And mortgage applications in the U.S. fell for a 6th straight week while mortgage rates hit a 12-year high. The Mortgage Bankers Association index of applications declined 5% to the lowest in more than 3 years. Meanwhile, the average rate on a 30-year fixed loan mortgage was up some 7 basis points to 5.2%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Earnings season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable.
We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan, spot on.
Delta flying. Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst?
Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We're pulling back on some of our spend growth across both content and non-content spend, but still growing our spend and still investing aggressively into that long-term opportunity. But we're trying to be smart about it and prudent in terms of pulling back on some of that spend growth to reflect the realities of the revenue growth of the business.
That was Spencer Newman there, the CFO of Netflix. That company this morning just absolutely battered. If you look at it in the pre-market, it's down and down hard by, what, 26, 27%? Think about where it ended last year. It ended last year at 602. It closed yesterday at 348. And right now in the pre-market, I'll get to that, Tom. Where are we now?
On sale.
253. We're down by 27%. TK just absolutely brutal.
It's fascinating. And of course, we focus on this, folks, not only because of, buy, hold, sell, and all the rest of it, but the impact here on all of our lives. John, as you mentioned, if anyone tunes into Saturday morning football, I just start screaming over the 6 choices I'm supposed to have.
It's a pain, Tom. You've got to try and find it first. And I've said it a few times now. You've got to pay for Hulu to get ESPN Plus so you can watch the Formula One. Then you need Peacock to watch some of the Premier League games. For the Champions League, you need CPS Paramount. And Tom, I can go on and on and on and on, and that's just live sport.
We're going to do what we do at Surveillance. We're going to talk to experts as we talk to Tim Nolan, way out front on caution on Netflix over the recent years. Now an exceptionally important and historic voice. Brian Weiser is legendary for his courage on Facebook when it was launched years ago. At Pivotal at the time, he's now Group President for Business Intelligence. At Group M, where away from buy, hold, sell, he really thinks about the trends in the industry. A definitive and constructive note on Netflix this morning. Brian, thank you for joining. I'm going to cut to the chase. Can Reed Hastings do a Brian Roberts? Can Reed Hastings move to a cash flow driven company a la what Comcast did years ago?
I think it is already. I mean, if you look at the most mature markets, the company is already very profitable. This is one of the things I think many people, certainly in the industry, ignore or don't think about. But the company produces a lot of cash flow already.
Well, the point here is the industry zeitgeist is he is no Brian Roberts, and you're saying, wait a minute, lose the caution. Can you own shares here given the collapse and your enthusiasm over their development of free cash flow?
Well, I would put it this way. I think that the expectations for the company were way out of whack. Way out of whack. I think that the investors were trying to make up business models that didn't exist.
Were they misled? This is too important. Brian, stop. Were they misled by Netflix?
I think investors found a way to justify the stock price. That's not uncommon, right? With momentum-driven stocks. You see it with any stock we'll call overvalued.
So
that happens.
So, Brian, how do you assess what the actual value is at a time when we don't even know what the real problem was? I mean, you actually throw some cold water on this theory that consumers were cutting Netflix subscriptions because of the rising commodity costs and the rising costs more broadly.
Yeah, exactly. I know that there's a narrative out there around inflation being issued, but you wouldn't see P&G with 10% organic growth or L'Oreal with double-digit organic growth if consumer spending was the problem here. I think the issue is, think about it this way. Spending on streaming services in the United States is about $30 billion last year. There's about $100 billion of spending on traditional pay TV services, traditional cable. There is an awful lot of room to go. And to echo Tim Nolan's points earlier, he was bang on when he talked about the competitive issue. That's the issue. There's just more streaming out there.
So, Brian, who's going to be the winner? A lot of people thought that Netflix would be the clear winner. Can you come out now and say it's a lot less clear that Netflix will be one of the winners of the streaming wars?
I think there's a very direct relationship between share spend on content and share viewing. If you spend $20 billion in the global industry with $300 billion, let's say, of spending on content, you'll get about 6% share of total viewing. It's actually pretty simple. The algorithm isn't that complicated. If you spend $30 billion in the $300 billion industry, you'll get more viewing. It's as simple as that.
Brian, I got to talk about the new mating that we have of Warner Discovery, Hulu, Animal Planet, and 47 other things, including CNN. They have $15 billion large of debt. I believe it's 56% of their balance sheet as well. Can Zavlev pull this off? Can he actually do the entertainment and news artistry of it and the financial as well and bring synergies to that new shop?
I think it's absolutely possible, of course. I mean, I think we're sometimes looking at this acquisition or transaction the wrong way. This is really a Warner Brothers takeover of Discovery, but inserting Discovery management on top of Warner. At least that's what it looks like based on the management structure they announced so far. To the extent that the company was really well positioned by Jason Kilar for a long future ahead, to the extent that David Zaslav keeps focused on that and doesn't focus on the short term, they'll do very well for themselves. I think the risk is that they start to focus more on short-term metrics, that they try to focus on making the quarter work. That'll cultivate a shareholder base they won't want. That'll lead to less optimal outcomes, I think.
Well, the quarter certainly didn't work for Netflix, that's for sure. Brian Weiser of Group M, thank you, sir. Fantastic to catch up. That stock is just down so hard, Tom, by 27% after doing the same thing off the back of the last quarter's earnings.
Yeah, the ballet from Weiser in his note, which is more constructive than most, is that Russia had a play here on Netflix. Everybody's dealing with Russia and Ukraine in that. But as he mentioned and Tim Nolan mentioned, the level of competition in the Faro living room, the Abramowitz living room, this is nuts. And Nathanson and others have been way out front of this.
The issue I have with what I'm hearing this morning from some of the more constructive views on the South side is that the most bearish note on Netflix in the last 24 hours came from Netflix. in the shareholder letter. This was the first factor. They had 4 as to why this has all gone wrong. This was the first one. It's increasingly clear that the pace of growth into our underlying addressable market is partly dependent on factors we don't control. The adoption of on-demand entertainment and data costs, the uptake of connected TVs, we believe these factors will keep improving over time so that all broadband households will be potential Netflix customers. But for now, Tom, you've got a company, the company itself, telling you that the addressable underlying market right now is a problem for them. That's the most bearish take out there. It's coming from the company.
To me, and I don't think it surprises anyone, I go back to the core feature, John, which is, does any given company show this strange word profitability? And within the big tech, Amazon, profitable. For whatever reason you can rationalize. Apple, profitable. Can you really say that about Netflix, given Hollywood accounting? And there's some people, Michael Pachter among others, that are heated on this.
We get the luxury of waiting. We can wait until the Walt Disney numbers come out and we get the Disney Plus figures. If you're in the stock right now, I mean, are you still in the stock? This is ugly and has been all year. From New York City this morning, good morning on TV and radio. This is Bloomberg.
Almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Live from New York City for our audience worldwide on TV and radio, here's the price action in the equity market. On the S&P, a kick higher for a second day to kick off this week. Going into the open about 60 minutes away, up 0.4%. On the Nasdaq 100, up by almost 0.5% on the Nasdaq. Yield to lower by 6 basis points to 287.44. And Netflix is a whole lot lower, down by 27.6% and near session lows. The South Side reacting as you might expect.
Yeah.
TK, JP Morgan, a cut to neutral, a new price target 300. Piper Sandler, a cut to neutral, a new price target 293. UBS, a cut to neutral, a new price target 355. And Stifel, cut to hold, a new price target 300.
I missed this on the break, John. I was doing my taxes. I'm a little late, and Netflix down to a 251 level moments ago. So I want to make clear this is a set of lower highs through the morning and off of yesterday afternoon.
At 300, seemingly, Tom, that price target is the new 500.
We will see on the opening 252.48 right now on Netflix. Diane Swank watches Netflix nonstop when she's not looking at the American economy and joins us this morning. Diane, I was really taken aback by a constructive world economic outlook yesterday on the United States of America. They have a fairly constructive, pretty good economic growth with inflation, pretty snappy nominal GDP. Are we over-glooming right now on the American economy?
Well, I don't like to be the Debbie Downer here, but I am really worried about what we're going to see in terms of the economy in the second half of the year as rates go up. We've already seen the yield curve back up pretty steeply, and mortgage rates have come up pretty dramatically. The housing market is going to be the canary in the coal mine, and I think we're going to see some pretty big declines in that market in terms of activity. And then the question is, what happens to home values by the end of the year? Some of the hottest markets already plateauing.
With Grant Thornton right now, Diane Swank, and Diane, just a few years ago, Bank One and the world stopped when Swank published on the American housing market. Diane, you've looked at a few housing cycles. What are we going to see here? Does the supply come on? What's the microeconomics under this stunning house boom?
Well, I think what we're going to see is now we're already moving back to sort of February 2020, a little above that kind of levels. But as we get into the second half of the year, we really are seeing those all-cash investors crowding out first-time buyers. But the cost, people forget, the percentage increase, the 2% increase we've seen in mortgage rates above 5%, holding above 5%, that movement up is bigger than it was back in 1994 when we went to 6.5% to 8.5% on the mortgage rate. Yeah, that's what they were back then. But it really is interesting is that people forget the percentage interest expense is that much higher. And I'm really concerned about the run we've had in housing and some of the hottest markets with 40% year-over-year gains. They'll probably be producing declines by the end of the year as the market cools. Overall home values, I think, will be flat by the end of the year for most of the country.
Diane,
that's a big change from double-digit increases.
That's a big change, but it's not all that scary considering how much the prices have run up. And actually, some people might say it will increase the affordability, particularly for people who do see their incomes crimped in other ways. What's the difference? What's the dividing point between healthy declines, actually very much in line with what the Fed would like to see, and something a little bit more material for both the economy and, frankly, for Wall Street?
Well, I think if we start seeing, we want to see home building catch up a bit and some more supply come on out there. That is good news for the housing market. But what I'd be concerned about is if we started to see home sales go back to more like 2015, 2016, or even 2014 levels, as opposed to just getting back to sort of the healthy levels they were at the end of the last expansion. And that's something that I think, you know, the dividing line is going back to the time when we really weren't buying many homes at all, and we were still coming out of the housing bust. And you're right, we've got a lot more equity in homes, and if home prices even are just flat, given the appreciation we have, they're still up a lot, and that's not going to destroy people's equity in their homes. But I do think it is a major shift in the environment and affordability on these mortgage rates. And I think first-time buyers, even with the wage gains they've got, they're already having a hard time buying out there. And that's going to be the real test, is can they stay in this market?
Diane, I made a mistake yesterday. I looked over in the morning before this show started about housing starts data and thought, this isn't going to be that relevant. It came out at the fastest pace going back to 2006, surprised the upside, and it had a market-moving impact. People took a look at that data and they said, wait a second, maybe the Fed isn't aggressive enough. Maybe they are not exactly understanding how fast the inflation is and how much momentum there is behind it. Do you agree with that sentiment, that the data on the margins continues to edify that story, that the Fed doesn't really appreciate what they're facing here?
Oh, I think the Fed appreciates it. The people who appreciate it most, we've heard the most vocal, certainly Jim Bullard and Chris Waller. And Chris Waller has talked about his own reality check of selling his house very quickly in St. Louis, but he can't buy anything in Washington because the market is crazy, as he put it. And I think that's really important to know, that the Fed is having these real-life experiences that everybody else is, because those are the two of the people, incidentally, that, of course, want Bullard talking about potentially a 0.75% hike. Those are the people who are most aggressive on rate hikes. I think it's interesting to me to see Esther George and Charlie Evans talk about, getting rates up, the need to do that. They're on board with a 0.5% hike, but they're also worried about the measured pace because markets have moved up. They need to support that, but they don't want to get too far ahead and trigger a bigger credit meltdown. And, we're starting to see tensions with Japan and their exchange rate now. We're seeing tensions with developing economies and their exchange rate. Every time the Fed raises rates, or even we think about raising rates, those other economies have to defend their currencies. And that is a much more sort of house of cards for the Federal Reserve to have to balance on that tightrope.
What is business investment doing, Diane? You've got such a unique view on that. Is the confidence still there to plan forward?
We're starting to see some erosion in that confidence, and we certainly saw it with the war in Ukraine. We are seeing, many manufacturers that we talk to and we survey them, they're looking to automate it because they can't get the workers that they need, but they're also dealing with a much more expensive equation. Many of the margins that you see on the traded stocks that you have, these are private companies that are middle market companies that are getting the most squeezed on margin squeezed by everything from labor costs to energy costs to inability to get steel and the components that they need.
Can they pass on cost?
And they do pass on costs, but it's squeezing their margins. And in fact, I know some in the business are starting to think about what part of the business do we want to stay in, what part do we want to get out of, because we can't pass along the costs enough. We're passing them on, it's inflationary, but there's a squeeze on margins, and that's what inflation ultimately does, is ultimately it shows up in margins. And you see, many of the big tech behemoths, well, they can absorb the shock to margins because they're leveraging and they're investing, and there are companies out there in professional services that are investing a lot of money that they can absorb the wage increases, and more broadly, they can absorb the other cost increases that they're facing. It's the smaller middle market companies, the bread and butter of the economy, they can't.
Given what we're seeing right now, Diane, how high do you think inflation will remain by the end of next year, especially given the fact, as you pointed out, that a lot of Fed officials are waking up to how much they have to do?
So by the end of this year, we're looking at core inflation to be running in the high 4s. And that still is pretty hot, and that's because we expect on the CPI measures of inflation to still see the pivot into services as a pivot into shelter costs most dramatically. We might see some backup in goods costs, and I think Charlie Evans pointed to that as well, and that's very important, that we'll get a break in goods costs, and then we could have some supply chain problems that push them up. But the real issue is what happens to that third that is rent and owner's equivalent rent, those home ownership costs. It takes over a year for the appreciation we've already seen in home values to show up. That's a lot of inflation still for the Fed, and it's too hot for the Fed to stop at a neutral rate. And that will be one of the determinants that we think pushes the Fed past the neutral rate and having to continue to raise rates into 2023. By 2023, we do expect to see 2% Fed funds rate by the end of the year, but we also have conveniently called a growth recession, which is an economy that stalls out and the unemployment rate creeps up a bit. That's the benign version of that.
Diane, you've been absolutely brilliant, and I believe the Fed decision is 2 weeks away, and we'll catch up with you again then. Diane Swonk there at Grant Thornton, 2 weeks away, May 4th, for the Fed decision. The lineup for the next hour on Bloomberg is absolutely tremendous. You will hear from David Malpass at the World Bank in just a moment on this program. In the next hour on equities with Laurie Calvasina and Mike Wilson on the equity market. Then around the open, we'll get into the bond market with Bob Michael of JP Morgan Asset Management. And on Netflix, the stock du jour getting absolutely hammered in the pre-market. TK will catch up with Michael Nathanson of MoffettNathanson.
Yeah, Craig Moffett and Michael Nathanson, along with a select group, have always been skeptical about the Netflix profit model, and it'll be interesting to see how Michael recalibrates this morning. I know he's been out doing the media rounds, but you know, I to your point, John, of where all those price targets are coming in, I'm really going to watch what this team that's been right, you know, including the guy at Macquarie, the guy at JMP Securities, the guy at MoffettNathanson, how do they reset, to me, is critical.
There were people tempted yesterday to buy into the earnings, Tom, after a move of more than 40% year to date. Coming into today, we're down another 27%.
Right.
There will be people even more tempted to buy this now. And that's the question for Mr. Nathanson of MoffettNathanson. Is now the time to buy? We would argue not yet, as we are still incredibly uncertain about what the revenue base in 23 and 24 looks like. Their view, TK.
John, it's real simple. The way that you learn not to buy into a Fed announcement or buy into an earnings announcement or that is to enjoy losing money when you buy into the announcement. I have enjoyed losing money buying into an
I'm not sure how many people have enjoyed this morning, Tom, if they're losing money this morning and through the year on this stock.
Brutal. And other stocks as well.
Down more than 27%. Going into the open in Bell about 50 minutes away. Equity futures are doing okay, up 0.4% on the S&P. On the Nasdaq 100, up 0.4%. Also, yields are lower, heading south, down negative 5 basis points on a 10-year to 288.41. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. In Shanghai, businesses from car makers to supermarkets are gradually resuming operations in the midst of that massive lockdown. Many factories are able to restart by using a closed-loop system. This is whereby staff work and live on site and undergo regular testing. Health officials say that 2/3 of Shanghai's 25 million residents are still locked down. Bloomberg's learned a small but growing number of senior Kremlin insiders are quietly questioning Vladimir Putin's decision to go to war. They believe the invasion was a catastrophic mistake that will set the country back for years. So far, these people see no chance the Russian president will change course and no prospect of any challenge to him at home. Just Eat Takeaway is considering a partial or full sale of its Grubhub business. The Dutch-based company says it's considering strategic options for its U.S. unit. That's just less than a year after buying it for $7.3 billion. It just highlights how the end of the pandemic has turned the food delivery industry from what was a hot property into a struggling sector. Abbott Laboratories posted stronger than expected first quarter profit and revenue. They were driven by high demand for the company's coronavirus testing products. During the winter Omicron surge, Abbott maintained its forecast for the whole year. And Lululemon plans to double sales by 2026, in part by targeting men. The athletic wear retailer wants to double the revenue it gets from men's products and its digital channel. At the same time, Lululemon wants to quadruple international sales from last year's levels. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Compared to our January forecast, we have revised our projection for global growth downwards to 3.6% in both 2022 and 2023.
The head of economic research and chief economist for the International Monetary Fund, Pierre-Olivier Grenach, is there. And I'll tell you something, the credentials he has out of the Massachusetts Institute of Technology and a thesis with Olivier Blanchard and Rudiger Dornbusch really bodes well for his perspective to the IMF in the coming years. Right now, the perspective of the IMF and World Bank meetings, or the World Bank and IMF meetings, when David Malpass joins us, the president of the World Bank, truly in time of crisis. David, I want to cut to one of the quiet stories here, and it does have to do with Russia selling an awful lot of fertilizer to the United States of America. Your shop is led on building the supply of fertilizer critical to this humanitarian crisis. How are you doing?
I'm happy to see more fertilizer is critical in this planting season. Countries are really at the moment where they need to get the crops in the ground and they need fertilizer. So that's good that Russia's doing that. I saw yesterday India was selling some wheat to Egypt. My view is that there really is a lot of supply in the world if it can be guided or if it can be allowed to find the best use.
What can your institution do to get us away from 5, 6, 7 standard deviation jumps in agricultural products?
We can help with data. We can help with the supply chains themselves. We can provide trade finance, which is important in moving goods around. And we can also encourage countries to find new sources, to realize that that they need to move quickly in order to increase supply. And importantly, Tom, we can encourage the advanced economies to do all they can to release excess stocks and to make more products. They have huge production capacity, and I think if they communicate that, that will help with the world pricing levels.
David, time has become incredibly important when we're talking about issues of hunger, especially for places where the average is half of the income of every household goes to spending for food. Sri Lanka stopped paying debt payments as a result of their need to buy food and fuel. How much do you see this as becoming a routine issue with debt defaults at a time when Sri Lanka says the IMF aid is going to take 6 months, which is going to be tough for them?
Hi, Lisa. Different countries are in different positions. Sri Lanka had waited in order to begin to tackle its debt problem, and they continued making payments on heavy debt burdens, including those to China, and so that drains resources. Other countries have faced different problems, each one unique. I was in Romania and Poland last week. They're facing the changes in the energy supplies within Europe. I'm sorry I missed Tom when he was in Washington, D.C. last week. But the point is that the world needs to have a resolution process for debt that's more robust than we have right now and starts earlier. At a meeting this morning, there was a call for China to convene a creditors committee for Zambia. I think that would be a very helpful step because Zambia stopped paying its creditors more than a year ago and still doesn't have a pathway to a debt resolution. I think the world needs to work hard to provide that path, and that would be a good step forward.
David, as we try to understand what the obligations are of some of the developing world, do we have a sense of how much is owed to China in terms of loans and other types of debt?
There's substantial data. It's not all transparent as far as what the amounts are. So the World Bank puts out numbers on that. You know, there's different ways to cut it, and so you have to be careful. The official debt, China is now some 65% of the total creditor amount owed to creditors of the official credits. That means government to government credits. So that's a right type of data. Another type is that the poorest countries are expected to pay out $35 billion of debt service this year alone, which is bigger than the foreign aid that comes in. And so there really needs to be a change. That was discussed heavily already this morning at IMFC meetings.
David, here's the distrust, and by no means am I casting an aspersion to you or your great institution. Our Christopher Yancey and his team are really looking at the basic flows of aid. The World Bank is always first to write the check. They're acclaimed for that. Are you writing a check to a given beleaguered nation, and they're turning around and taking part or all of that check and rolling it right over, FedExing it out to Beijing?
We hope not, and we're working to avoid that. But the system has been one where that has allowed transparency to go down and down. And so in many cases, there are non-disclosure clauses in the debt contracts that leave it unclear why the payments are being made to the creditor, oftentimes to China. I think there can be big improvements, and it's also in China's interest to do that. And so because China is a big part of the world economy and can benefit from healthy countries and healthy development in the developing world. That's what I hope.
Okay, you hope for that. Hope's only going to get us so far, Mr. Malpass. Is there any indication China wants greater transparency so the check you're writing is not going to Beijing? I mean, do they want transparency?
Yes, they're fully participating. Then the devil is in the details, Tom, as you know. And they've explained that they're willing to be more active in these debt resolutions if they can actually play a formal role. People are discussing this concretely, that the world was set up under the old debt composition in which China wasn't a big player. Right. So China's not a member of the Paris Club. It's been the central institution to restructure debts. the G20 is trying to broaden that, and I think they're making some progress.
Yeah. David Malpass, thank you so much. The spring meetings of the World Bank and the International Monetary Fund. He is president of the World Bank. Lisa, there's like 8 things to talk about, and the one thing I got to go to is Netflix. I mean, it's just broken down again. We almost got a 250 print exactly, but we're at a 251 handle right now.
Yeah, down almost 28%, down almost 70% since the November high. I keep going back to why. Is this an issue of people cutting back because of the cost? Is this because people have other stuff to do and they're not willing to spend whatever it takes to entertain their children in a lockdown because of a pandemic, right? I mean, how much are we looking at something that is specific to Netflix and something that's a broader economic story, Tom?
Well, you know, we'll see. And again, it's the earnings season upon us, and I gotta believe there's gonna be other Netflix as well. We'll have continuing coverage of this through a very, very eventful end of April here. Let me do a data check. I'm gonna focus on currency, which, to be honest, I think I ignored today. I'm sorry for that, folks. DXY, 100 level, yen, a 128 level, a little bit of yen strength, but it is ever so fragile. Euro, it's okay, 108.27 there. Euro as well. Sterling, we won't mention. We don't want to upset Pharaoh into the next hour as well. Please stay with us through the day. Dow futures up 149. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Live from New York City this morning. Good morning, good morning. This morning, all about one name, Netflix, down 28%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, kicking off big tech earnings.
It's been a brutal year for big tech.
Real yields matter for equities.
We had that collapse in real yields, which boosted the valuations.
We had such a run-up in tech.
You've got the reverse situation now.
Tech has been hit really since the start of the year.
Tech has been the area of the market most punished by that combination of higher yields and inflation.
The risk is that earnings forecasts are still too high.
Valuations are an issue.
As real yields hit positive territory and as the Fed starts to move.
It's not a great outlook.
Ultimately, the question is going to be
which companies are going to be able to defend their margins.
To what extent does consumption start to decelerate?
The buzzword for Q1 is uncertainty and price pressures and margins.
Joining us now, all-star lineup, RBC's Laurie Calvasina and Morgan Stanley's Mike Wilson. Laurie, let's start with you. Do we have a Netflix problem or a market problem?
Hi, great to be here, John. Thanks for having me as always. And look, I'll tell you, as I look through the earnings numbers that are coming in and all the commentary that's coming in, I still see evidence of a very healthy consumer, of an economy that's not cracking. And we do see this handoff from, sort of the stocks that did well during the pandemic back to the services side of the economy. And you've seen that in a lot of the terms of the goods companies stumbling. So I think that we don't have a massive market problem at this point in time. I think we have some concentrated pockets of risk to navigate around. But I do think that the market has rallied, very strongly off these March 8th lows. And I think the market deserves to be where it is right now.
One concentrated pocket of risk is called Netflix right now. It's down 28% in the pre-market. Mike Wilson, do you think we're underplaying the cyclical story embedded in some of these big tech names?
Yeah, we do, John. I mean, our fire and ice narrative is, I think, playing out. And while I agree with Laurie that there's evidence that consumers hanging in for now, I mean, the market is worried about something because it's really historic how defensive the market is trading. Okay, so while the S&P 500 is only down, 6-7%, which is pretty amazing in the face of the rate rise, I would not take comfort in that. Because the real signal underneath the surface is a market that is really shuddering about something, whether it's the war in Ukraine, the Fed itself, we know about that, of course, and then maybe there is a growth slowdown that the market's starting to contemplate. We don't have evidence of that, hard evidence yet, that earnings are going to have to come down, but we do think the signal from the market's pretty clear. Now, the good news on that is that the market's sort of priced for it, right? So if you have a different view, if you have a view that things are going to reaccelerate here or stay strong, then you should be rotating into the more cyclical parts of the market. That's not our view, but the market is speaking loudly, and we think it is saying that we have a cyclical slowdown here. And last night's results, kind of portray our view, which has been all along that there's a giant payback in demand, not only for the obvious winners of the COVID pandemic, but technology broadly, is a cyclical group. It is a cyclical industry. And this has been a building sort of view that it's secular and it's not cyclical, and that's just wrong.
Well, Mike, your view also is that inflation has been a tailwind for revenue growth over the last year or so, and it starts to become a much more prominent headwind for earnings. Are we going to see that this quarter in these earnings?
I think we'll see some evidence of that, John, for sure. I mean, we've already heard about it from some companies. I mean, clearly, the spike in inflation from the war, on food and energy specifically is going to be like a tax on the consumer. I do think that will have an impact going forward, whether or not it has an impact, in the first quarter. But yeah, the inflationary tailwind, which has been just a straight through pass through to top line, which, by the way, that's why we have inflation, right? Because companies don't pass it straight through. Now we're seeing the latent effects on costs, and that pricing power may not be as strong to pass it straight through, and then we should start to see that margin pressure. Once again, I would say the good news is that margin forecasts have come down over the last 2 or 3 months in line with that view, meaning if last quarter, fourth quarter was 14% net margins. The forecast now for Q1 is 12.5, 12.6 to be exact. And we think that'll persist through the rest of the year. So the risk is that those margin numbers have to come down for the rest of the year now. and we're going to learn a little bit about that during earnings season. We think they will.
Netflix, the focus this morning, that stock getting absolutely hammered down to 251 in the pre-market, negative 28%, and set to erase about $40 billion plus off the market cap after going into yesterday down already year to date by more than 40%. Ed Ludlow has more on the story from the West Coast. Morning, Ed.
Yeah, good morning, John. If we hold those losses, Netflix will become the worst performing stock year to date on the S&P 500 and the NASDAQ 100. The top line, a surprise 200,000 subscriber loss in the first quarter, but really you go straight to the outlook for the current second quarter where Netflix expects to lose 2 million subscribers when the street was hoping they'd add 2 million. Look at that chart. This is the FanMag basket, right? The mega caps. And when Netflix drops, it's often the worst performer within that basket. And I know we're going to talk about the details of what happened at Netflix, John, but we've got to frame this in the context of an intense 10-day earnings period for the technology sector. We went into this quarter, and I urge you talking to Mike about this a moment ago, with raised expectations or rising expectations for profit across the technology sector in the context of inflation and increasing prices and passing that on to the consumer as a guard to boost margins. Does our psychology change? I was sat at this desk last night after those earnings dropped from Netflix during the call. I looked at what was moving in the market, not just Netflix peers, but also higher multiple tech stocks, the stay-at-home stocks really getting hammered. Now I look at NASDAQ 100 futures. We were lower throughout the morning. I think we're a little higher now. You have to ask, what does Netflix do to reset the psychology of investors about where we are in the economic cycle and what Netflix indicates for particularly companies that are consumer-focused but subscriber-focused, of which there are many reporting over the next 10 days or so.
We're going to wait for Disney Plus in the first couple of weeks of May. Ed, we're going to touch base with you again in about 30 minutes' time around the opening bout. That stock is going to get punished at the open. Ed Ludlow, thank you, sir. Laurie, to come back to you, Mike talked about it. The defensive bias in this equity market, pretty clear for everybody. Your words, you've said it's hard for you to like defensives right now. Why, Laurie?
Well, if you look at the defensive sectors, areas like healthcare, consumer staples, utilities, the valuations have already run up. So we're actually seeing quite elevated valuations relative to the S&P if you then look at where those levels are versus history. We also have pretty poor earnings revision trends in most of those sectors. And I will tell you, John, the consumer staples sector is one that really kind of mystifies me right now. Mike mentioned Russia, Ukraine, potentially putting some pressures later on this year. And, you know, if we think about sort of a sector that is absolutely at the epicenter of every single risk, both primary and derivative, that you can associate with the Russia-Ukraine crisis, it's consumer staples. So the idea that that sector's been showing some resilience, you know, when we have some of the bears in the market talking about kind of the Russia-Ukraine pressures that are coming in, and I agree that those are real legitimate pressures, it just makes absolutely no sense to me that the staples sector has been outperforming.
Mike Wilson, talk to us about that. Two views make a market. I know you're on the other side of this particular trade.
I mean, staples we're neutral on, so we're overweight the other three defensive areas: healthcare, REITs, and utilities. And I agree with Laurie's comments. We do own some of the staples names in our model portfolio, but you got to be way more rifle-shotted in that regard. Meaning picking the staples where they either don't bear the inflationary costs of food and et cetera, or they have an ability to manage it better. So it's just a much more idiosyncratic situation. So, but look, going back to the defensive story, I mean, just to be clear, John, I mean, we've been overweight defensive since November, and I agree with Laurie. A lot of that's played out, to our benefit. I would not necessarily be chasing these stocks here. However, given our view for the broader averages and the cyclical stocks to continue to kind of struggle here potentially on this payback, we do think the defensive areas will hold up better, and those three sectors I mentioned are the ones we would favor.
What you're both on the same page on, in a bigger way, I think, is that we're shifting here from focusing on upside risk to inflation to downside risk to growth. Morgan Stanley, Mike, you and the team have been writing about that repeatedly. Laurie, you were looking for that story to really become a little bit more pronounced in the second half of this year and then start to shift towards tech. Is that still the way you see things working out?
We do, but I want to be very careful in terms of what we mean by tech, because, some of the companies that have been discussed earlier are not actually tech companies. They sit in the communication services sector, and that's a part of the growth trade that we've been quite cautious on. We've actually been underweight that sector. Most of your consumer-oriented tech companies are sitting in consumer discretionary as well as comm, but more of the corporate side of what most people will refer to as tech is actually sitting in that classic tech sector on the GICS methodology. And we think that's a very intriguing area, just given valuations that have come in and look quite, elevate or underappreciated versus history. We actually have, sort of cheap valuation conditions in the tech sector proper for the first time in quite some time. Quality is high, earnings revisions have been strong. And I'll tell you, John, I think that we've, sort of talked on this program so far a lot about kind of binary choices, but we actually view the world as having three choices: secular growth, defense, and cyclicality. And what we tend to see when you get past the first Fed rate hike in the market, and when you start to see GDP expectations coming down and heading back towards sub-trend type levels, we actually do tend to see growth start to outperform value again. So that growth part of the market, while we would be very, very selective in it and really stick with tech as opposed to comm services, we think that's really an area to be in as we transition away from this hot economy to a cooler economy that doesn't necessarily tip into a recession.
Mike Wilson, your thoughts?
Yeah, no, I think having some sort of mixture there makes a lot of sense. I mean, we've chosen the barbell of sort of defense with some cyclicality being, some energy. We recently downgraded financials because it had the run and it wasn't participating with the rate move. But I do think you need to have some cyclicality in your book. And I would say at this stage, we still would prefer kind of the late cycle winners, meaning energy materials, over technology, which is more of a mid-cycle performer. But I do want to, address this once again, this issue around technology. I mean, maybe the multiples have come down here a bit, but to me, whenever growth stocks are derating, it's usually a word. The market is saying that the numbers are probably going to be under pressure, and I stick with that view. I think that we're going to be surprised again. How broad-based the pull forward was. I mean, I've been hearing this for 6 or 8 months now. People saying, "Well, it's only these companies," and then all of a sudden another one, in your face blows up. And I think we're going to see a lot of that. I don't see how the pull forward during COVID, there's not going to be a big payback. And a lot of the technology spending, particularly in the semiconductor space, where the supply chains have been a mess, which creates a false sense of security on orders, that's going to play through now in the second and third quarter.
And Mike, I just want to build up that particular view just a little bit more. Just one more question, if I may. A lot of people have reduced that story to stay-at-home stocks. Netflix, Zoom, the names. Are you saying it's much, much bigger than that?
Yes, absolutely. I mean, I don't know how it's just the math. I mean, just like the consumer goods companies, saw spending well above trend, we saw the same thing in things like software and things like PC consumption, handset consumption, server consumption, cloud expansion. I mean, it's all over the place. So, I think it would be naive to suggest that they're going to be immune to the payback in demand, whether it's corporate or consumer. Okay. I mean, I've used this analogy a lot of times, which is, COVID was much like Y2K, where, you just had a pull forward. Companies had to do the spending to make sure that they were secure for the transition to the new millennium. It's no different. Companies digitize, they pull forward years of demand in some cases, and there's going to be a payback.
Laurie, final word?
Look, there may be a payback at some point in time on the corporate side, but we like the software space a lot in particular because the environment is going to remain challenging for quite some time. And I think there have been a couple things that have been underestimated. One is the psychology of the reopening that does push that services side of the consumer forward. And I don't see any payback there anytime soon, frankly. But if you look more on the corporate side and the productivity enhancements, a lot of that is being driven by the tech sector and the software space in particular. And as long as inflation levels remain elevated, supply chains remain a challenge, there is going to be pressure on corporate margins, and software is one of the tools that has gotten companies through the past few years. I don't see that letting up anytime soon. So while there may be a payback, I really don't see it coming to, sort of the corporate side and any kind of relief in terms of that need to just really keep the productivity enhancements going forward. I think that's around for a while.
Laurie and Mike, sticking with us. Into the open about 20 minutes away. Equity futures doing okay, up 1/3% with some movers into the open. It's Taylor Riggs.
John, Netflix has reported earnings. Not sure you were aware. It has been the biggest story since 4 o'clock yesterday. The story well continues into today as we look forward to the pre-opening trade, as you've been mentioning all day long. I've been scouring through the research notes. I'd argue MoffettNathanson out with one of the best on the street, really highlighting not only the maturity of the U.S. and the Canadian markets, but admission really that they have to go back into the advertising model, and unclear why they didn't do that sooner to limit the growth that all of their competitors have seen. That, of course, is a big one that we're talking about. Twitter, we try to do fundamentals on this program. There's more cryptic tweets coming out. I'm not smart enough to decrypt them. But again, Twitter shares rising up about 0.7%. Lululemon's an interesting one, John, because a few weeks ago they introduced running shoes for women. They're now coming out and they want to double their sales by 2026 in a new 5-year plan. And they're also targeting men now in this one. So if they develop a line of men's running shoes for you, we both can be happy. Let's talk about Procter & Gamble, because we've been thinking about the consumer staples and the defensiveness of this market. They had top-line sales revenue now more than 10%, one of the biggest that they've had now in about 20 years. Price hikes offsetting those costs.
Taylor, thank you. As always, Taylor Riggs there. Michael Nathanson at Moffett-Nathanson is coming up on this show later this hour. We'll catch up with him at 9:45 Eastern Time. Coming up, central bankers growing increasingly hawkish.
Probably we are going beyond neutral. When I see that taking out special factors, I'm still left with 3 to 3.5% inflation. That's not what we want.
Inflation keeping the pressure on the Fed. That's next.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Earnings season is here.
A moment of multiple crises.
Bloomberg is fastest with the numbers and analysis.
You do have some good news and bad news.
It's a good time to own volatility.
Bloomberg, the fastest numbers and analysis you trust.
Probably we are going beyond neutral. I mean, that's my expectation. When I see that taking out special factors, I'm still left with 3 to 3.5% inflation. That's not what we want. If the 2.5% inflation rate, I think we have more things to ponder there.
As you might expect, we have some division within the Federal Reserve. Atlanta Fed President Raphael Bostic pushing back a bit, saying, quote, "I'm reluctant to really declare that I want to go along way beyond our neutral place because that may be more hikes than are warranted given the economic environment." Raphael Bostic to CNBC in the last 24 hours. Mike McKee, good morning, sir.
Good morning, John. Well, I don't know if the Romans did monetary policy, but they do have a saying that fits: Citius, Fortius, Altius. Faster, stronger, and higher. The question for the markets is how strong, how fast, as you get those disputing views from members of the Open Market Committee. Here's the Charlie Evans view. What we're looking at there is the effective Fed funds rate now after their first 25 basis point move. The blue line is where the Fed is going to be at the end of the May meeting, up 50 basis points, and another 50 basis points priced in for the June meeting, but the arrow points to where they have to go, above the neutral rate, which pretty much all of them still say is between 2 and 2.5%. How fast do they get there? Well, every day it seems they're going to have to go faster. These are two financial condition indexes, the Bloomberg one in orange, the Chicago Fed in white. They use different scales, but they tell you the same thing. If you look all the way over on the right, the Bloomberg going up, the Chicago Fed going down, that means conditions are getting easier. They've raised rates, and financial conditions are getting easier. And here's the decision in the markets. This is the Raphael Bostic view, I guess. The white line where the market thinks the Fed funds rate is going to be going over the next 2 years. But the blue lines, Eurodollar futures, are saying they're going to break something along the way, and we're going to see rate cuts by 2024. How you price this all, I don't know. How the Fed decides, I don't know.
I think we can pass the buck on this one, Mike. We'll let the investors figure this out too. Mike McKee, thank you. Laurie Cavacina, Mike Wilson, back with us for a final thought here. Mike, even if I could, and I can't, but if I could forecast the Treasury market with perfect precision, I've got no idea what it means for stocks anymore. Yields up in a big way, banks down. Yields up in a big way, utilities doing well. What is the link between the Treasury market and equities at the moment, Mike?
You know, we spent a lot of time on this, John, as you know. We've written about it. We're equity people, right? So, we trust the equity market. Some people will say the bond market's smarter than the equity market. I would argue that the internals of the equity market are the best strategists in the world, okay? And so we're taking our cues from what you just said, meaning the defensive posture, the fact that banks are not working as the yield curve has even re-steepened here, a little bit better, but not much. Utilities are screaming as rates are going through the roof. Even the bond proxies basically are leading. The equity market is saying there's no way the Fed is going to get all these hikes in. It's calling BS on whether or not they can get through all this, because they will break something, whether it's the markets or the economy, or they don't necessarily have to break it. They'll just pause, right? So just pausing would suggest that rates at the back end have already moved too far. It doesn't mean recession, by the way, but it's the equity market's way of saying the Fed's going to go too far, too fast, and that's why the equity market internally is kind of hiding in these areas.
Laurie, what's your take on this?
I actually agree with Mike on this. We did a survey a few weeks ago, and we found about half of the investors in our survey didn't trust the Fed and thought there was a risk that they were going to go too far. And I think that's why, some of these defensive sectors have been lifting, despite the fact that they really shouldn't. There's really no other reason than recession fears building that things like staples and utilities should have been outperforming recently. And I think that we are going to see more evidence of the resilient consumer that corporations are pushing through. I think these recession fears are going to fade. And then we can see the financials take back some of the leadership they'd seen last year. We can see them recover. But I do think, I actually agree with Mike, and I love the statement. I think the internals of the equity market have it right and are the best thing to look at right now.
Laurie Cavacina and Mike Wilson. Just a tremendous lineup going into the opening bow to you both. Thank you very much. With Netflix down and down hard and trying to work out whether you can get a cyclical read off the back of this story. We'll continue that conversation. Coming up in the morning calls and later, Netflix set to lose roughly $42 billion in value after reporting subscriber losses for the first time since 2011. Make this work for me. The market looking for 2.5 million subs, it got negative 200K for last quarter. For this quarter, looking for positive 2.5 million subs and getting a projection from the company of negative 2 million. When there is a spread between the street and the C-suite that is that wide, you've got a major problem. And that's what we've got in the equity market this morning, with Netflix down by almost 30% now. From New York, that's next.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Minutes away from the opening bell in New York this morning. Good morning. Trying to build on the gains of yesterday. We're doing okay on the S&P, up a third of 1%. On the Nasdaq too, up a third of 1% also, even with that big move lower in Netflix, which we'll be hitting on through the day right here on Bloomberg. Switch up the board and get to the bond market. 2s, 10s and 30s. This curve just a little bit flatter this morning. Yields lower at the long end by 6 basis points on a 10-year to about 287, 288. That's the price action here. The morning calls. First up, Barclays upgrading Avis budget to equal weight, growing more constructive on the car rental space amid persistent inflation. That stock is up by 2.3%. KeyBank cutting its Alphabet price target to a street low 30.75, expecting a challenging quarter with macro pressures weighing on advertising budgets. And finally, B of A downgrading Netflix. They're not alone, cutting shares by 2 notches after reporting subscriber losses for the first time since 2011. Up next, much more on that story. Netflix poised to become the year's worst performer in both the S&P and Nasdaq 100. Then on the bond market with Bob Michael of JP Morgan.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
24 seconds away from the opening bout. It's Tuesday morning. Good morning to you from New York. I believe it's actually Wednesday, isn't it? I'm lost already. Futures are positive by 0.4% on the S&P. On the Nasdaq, positive by 0.7%. Switch up the board and get to the bond market. I'll rattle through the Treasury market for you as the opening bell rings in New York. Yields unchanged on a 10-year, 288.80 on 10s. We come back a little bit after having a little look at 3% on 10s and also a positive real yield. In the FX market, one policymaker at the ECB talking up a rate hike in July. We'll see. Euro dollar 108.37, up 0.5% there. Crude up 0.6% to 103.16. And the only stock to watch, it's Netflix. Let's get to the West Coast to catch up with Ed Ludlow. Hey, Ed.
Netflix did actually have a lot of answers to what's going on. So in that first quarter in America and Canada, they said that those higher prices on the platform resulted in attrition, right? Net loss of 600,000 subscribers. Russia, they lost 700,000 users because they shuttered their business because of the war in Ukraine. That meant a net loss of 300,000 users in the EMEA region. And there was a bright spot, Asia Pacific, up 1 million users. Some of that local language content in markets like South Korea giving them a boost. But I heard you ask this question a few minutes ago. Well, what about the outlook for 2 million user loss when the street's looking for 2.5 million users to be added in the current second quarter? And essentially, the tailwinds of the last 2 years, i.e. a pandemic that kept us all at home, have now become headwinds. We're emerging from our caves. We're going out there and spending less time watching content. That is something for them to consider. A lot of the analyst chat is about how content isn't enough. And if it is, they're not making the right kinds of content. I think we see some of Netflix's peers on the move as well this morning, lower, broader concern that this trend will reverberate through the streaming sector. You see Disney down 4%, going to be really interesting to see those earnings in a couple of weeks' time. The reality is, if you look at this terminal chart, we have dropped a long way from the peaks of 2021 on this basket of streaming companies, right? The narrative has changed. Driving this growth is no longer volumes. And if you read across the analyst notes this Wednesday morning, they talk about household penetration. In other words, Netflix has high household penetration. The addressable market, the room to grow, simply isn't there. We're on course to lose $42 billion of market cap, John. Netflix on course to become the worst performing stock in the S&P 500 and NASDAQ 100 year to date. But if you look at history, which we like to do, and the relative drops of some of the mega caps, $42 billion isn't that much. And we started the show by talking about how we were higher on NASDAQ 100 futures, the market relatively sanguine. You do wonder, though, if you look at this and think, what's going on in the bigger picture of this earnings season across the technology, and as one of your guests pointed out, communication sector as well?
I couldn't agree more. Ed, we'll catch up with you in about 10 minutes or so. On the year to date, that stock is down by 59%. And some, down right now by 30 percentage points. On the year, we've lost almost $160 billion in market cap. We've had a massive move, and it's not just an earnings story. There's a valuation story, a multiple story, and you've got to look to the bond market for that, because overnight, very briefly, positive real yields on a 10-year. Let's get to Kaylee Lines for more. Hey, Kaylee.
Hey, John. Yeah, brief indeed it was, but it was the first time real yields have been in positive territory going all the way back to 2020. And right now we're only negative by about 4 basis points. So really not that negative, which raises a question of whether or not there may indeed be an alternative to equities. Is TINA thrown into question? But of course, as we've seen this move in real yield, is because we've seen a really massive move in nominal yields as well. We're about 140 basis points higher on the 10-year today than we were on January 1st. And that's not just a U.S. story. It's true across the world. Boons, gilts, BTPs in Australia, wherever you look, basically yields are higher. What's interesting, though, in talking about how this relates to the equity market, we've seen equity volatility coming down as measured by the VIX, which we see here in white, while bond market volatility, that MOVE index in blue, is moving higher. FX volatility moving higher as well, though how much of that is really just a rate differential story? You need only look as far as the Japanese yen to see that evident. Finally, outside of sovereigns, I want to touch quickly on credit as well, because from investment grade to high yield, it is all down on the year, but actually investment grade has been underperforming, showing it's not so much a story about quality as it is about duration. And that is evidenced by bonds that have 10-year plus maturities down nearly 20% in 2022 thus far, John.
Kelly, nice, thank you. BFA with a big call this morning. Get long the 10-year. targeting a move to 225. Mark Cabana and the team over at B of A looking at this. We believe today's 10-year rate offers an attractive level to buy. Our forecasts point to inflation peaking this quarter and falling steadily in 2023. We believe this will reduce the panic level around inflation and allow rates to decline. A man with a view on this, I'm sure, is JP Morgan Asset Management CIO Bob Michael. Bob, let's start there. What do you make of that B of A call, Bob, and we can take it from there?
I think it's a reasonably good call. We've had a tremendous backup in yields. We think that the Fed gets to about 3% on the Fed funds rate over the next year, and that's a pretty good spot to pause. It gets them to a positive real yield on their 2% inflation target. The curve should flatten around there, and you have to appreciate the near doubling in 10-year yield since the start of the year. So finally, after a couple of years, we're getting the bond market to the right pricing. Frankly, I thought we would have had more repricing at the end of last year. Looks like we saved it all up for this year.
Bob, how do you judge that 3+ on Fed funds is sufficient, that 3 to 3.5 is sufficient? How do you make that judgment?
Well, I don't. And I think about where is a reasonable place for them to get to, how quickly, and where do they stop? And I think you have to listen to what they're saying, and they're desperately trying to get the market to agree to front-loading rate hikes. They know how far behind inflation is, and I hear you and Callie talk about, real yields are about 0 on the 10-year. That's deflated by everyone's imaginary guesstimate of where inflation will be over the horizon, not where actual inflation is. So they've got a battle royal on their hands, and I think they're going to really press, and the market will take comfort that we have a serious Fed looking to rein in inflation.
Got a serious Fed, perhaps, or getting more serious for some people. An ECB that could get in the game later this year as well, and a BOJ, Bob, that wants no part of this whatsoever. Is that setup sustainable into year-end?
Oh, don't be so sure about the BOJ. Inflation isn't only confined to the U.S. and Europe. They're also experiencing it in Japan. For sure, they want to get through Golden Week, but let's see what happens at the end of the second quarter when they're beyond Golden Week, if they're still supporting 25 basis points at the 10-year.
You think they back away from that yield curve control, Bob? Is that your call?
For sure.
And what do you think they allow that to get to? Do you think that's down to market forces, or do they just push up the cap?
I think they'll just back away and leave it to market forces. And I think, frankly, it's about time.
What would all this mean for credit, Bob? Last time we saw something similar play out with QT, the Fed hiking rates, going through neutral, positive real yields. The credit market seized up in the United States. Yet this time around, you're quite constructive on credit. Can you reconcile those things for us, Bob?
Yeah. Emotion tells you to hate credit. It's in free fall. But you have to appreciate the repricing that's happened. There's been a tremendous backup in yields. There's been tremendous de-risking. That combination of wider credit spreads and higher yields means you're not buying high yield below 5% anymore. You're buying it at close to 7%. You're not buying investment grade at 2%. You're buying it at close to 4%. So from a repricing perspective, things look pretty good. Then you have to look at what does corporate health and the consumer look like? Well, the consumer is 2/3 of the U.S. economy, and the consumer looks fine to us. The consumer looks able to withstand the pass-through of inflationary pressures. And I think you need some combination of 3 things for the consumer to be able to withstand that. The first is they need cash. Well, guess what? Deposit balances, thanks to the fiscal transfers, are still at their high. So they've got the cash. The second you need are higher wages. Well, guess what? They're seeing the greatest wage gains in decades. And the third thing you need, and this is where the Fed needs to step in, if prices keep going up and it starts to put pressure on your cash and your wage growth, then you have to be able to finance your purchases in a low-cost way. And right now, that's happening. So I don't see a recession this year. I think the market's a little panicked. I'd rather take advantage of the repricing and credit.
We didn't have a recession in the back end of 2018 either. What we had was QT. And Bob, are you comfortable with QT and balance sheet reduction, given the size of QT we could get? into year end and
So
through next year too.
whoa there, partner. I don't think QT had anything to do with the recession. I think if you go back to 2015 to 2018, the Fed played it as well as anyone could have played it. I think what caused the recession, and we've gone back and poured through our notes and our minutes of our various meetings, was the trade war. And in fact, the economy was doing so well, it created capacity for the administration to ramp up the trade war.
Well, just to be clear, just to jump in and clarify what I'm trying to say here, I'm trying to say that QT hit the credit market in late 2018, in December 18. Are you saying that's not the case?
I'm saying that's absolutely not the case. I'm saying it was the trade war that raised the prospect of recession and caused a complete repricing of credit.
Interesting. Bob, should we finish on Liverpool? How happy are you after yesterday?
Glorious. The quadruple is in the frame.
You think so?
Oh, I think so. I think they're the best club in football right now.
Bob Michael, that's the appearance fee. I just have to talk about your football club. Bob, great to catch up with a different view on late 2018 and December 2018 when the credit market really fell apart. Falling apart right now is Netflix stock. That stock is down by 32%, coming up, shedding subscribers when we were looking for something north of 2 million.
I know it's disappointing for investors, and it is for sure, but internally, we're really geared up, and this is like our moment to shine.
The understatement of the year from the C-suite of Netflix. Up next, Michael Nathanson of MoffettNathanson.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
investors, and it is for sure.
It's just a softer seasonal quarter for us. We have this addressable market that's expanding over time.
Internally, we're really geared up, and this is like our moment to shine.
That was just a litany of excuses again and again and again from the C-suite. The shareholder letter is full of them as well. The stock is down by 32%. Back with us is Ed Ludlow. Hey, Ed.
Sweet putting on a brave face, isn't it, John? I mean, we're down 32%, as you say, $49 billion of market cap loss. Year to date, the stock's now down 60%, and there's just dozens of analysts cutting price targets and downgrading their calls on the stock. We started the year with the average analyst price target on Netflix at around $680 a share. We're now at $366 a share in terms of the 12-month average analyst price target. And I guess the question is like the direction of travel. The growth story that the Netflix executives painted is very different to one I've been listening to in prior quarters. Mature market, US and Canada, changes there. The growth is coming in emerging markets. And I think your next guest coming up has a real focus on revenue per user and where that growth comes from going forward. But the big word that we got was advertising. In July of 2019, Netflix executives went on that same call and made the case that advertising was not the right direction to go. Now they're talking about a lower priced product backed by ads. And what they're saying, Reed Hastings in his own words, is there is an addressable market for that. There is a consumer out there that can stomach the ads at a lower price point. But will that actually help? There's also questions, of course, around content going forward. What are you watching at the moment, John? I mean, here we are talking about Netflix, a fundamental U-turn in strategy of ads, a U-turn in the stock. And a lot of analysts also still talking about content. There's no big hit that you and I are talking about right now that keeps me focused on this platform. And to protect margins, the big take for me on the call, you have to protect shareholder interest, right? To protect margins, they're also going to phase down spending on content going forward.
Ed, thank you, sir. We've got to spend some more time on this. MoffettNathanson kind of gets Netflix price target down to 245, saying the following. We've witnessed the company go from growth to growth purgatory in an instant. Yet the question from here is whether the company has gotten cheap enough for new investors to step in and buy. Their words, we would argue, not yet. Michael Nathanson joins us now for more. Michael, we've got so much to discuss, buddy. What on earth happened here? How was the market at 2.5 million and they're at negative 200K, and even worse for the quarter we're in?
John, it's mind-boggling. You know, we always had our doubts, right? But the question is about price elasticity. It's about competition. It's about maybe the consumer being a bit tapped out, besides what you just heard before from JPM. You know, there are a lot of factors here, but just the company's unwillingness to kind of address some of the issues they addressed in the call yesterday. I mean, this could have been done a year ago, 2 years ago, just kind of preparing people for this pivot that they hit a point of maturation. They need to have a different strategy, right? It's all feels so sudden, like they didn't see it coming, which is weird because it's a company that's been so good historically at pivoting right at the right time.
Do you think we'll see the same thing on Disney Plus in a couple of weeks, Michael, or is that going to be a different story?
I think Disney Plus has starting from a lower base. But John, the question I have on Disney, and we're neutral on Disney as well, is
sure,
do they have the right strategy, right? They went from a super fan strategy to trying to be a Netflix-like, global dominant platform. And I think that's the wrong strategy, right? I think they should pull it back to just be a smaller service with higher pricing, catering to their fans, not move into other verticals, in terms of content verticals. That's not the path they're on. They also had a great 2020 because of the pandemic. They raised guidance, and I wonder, was that a mistake? We've been holding off because we think they have to basically come back and revisit their strategy.
Michael, just in terms of this ad-based model that Netflix is going to push out now, how long do you think this would take to actually give us some growth, give us some results? Because the numbers I'm seeing, a lot of people are saying 2 years. Got to wait 2 years for something like that to generate the results we need to see.
Yeah, well, the big question for me to start is, what's the price point, right? Like, they've sold in 70 million U.S. homes at $15. That's a great business model. It's without the growth, right? The question is, what do you do, John, to get people to take advertising? How much do you cut the price? And they've been raising price forever, so all of a sudden you become ad dependent, more cyclical. You compete with people who are in the business. You have to add sales force. You have to change the content offering. Like, it's going to be very disruptive for the core Netflix fan to have advertising, right? We've all skipped through titles That's how closely we binge, right? We skip titles. Now you're going to tell me between my next episode, I'm going to have a 2-minute interstitial with commercials. That's not the product that we signed up for. So that to me last night, the comment by Reed, you guys played it, felt like it kind of came out of left field, right? It's something they wanted to say maybe to stop the bleeding, but it wasn't well thought out. It wasn't in the investor letter. It was kind of a strange way to admit a strategy change.
Michael, we've had a lot of other people on the street, and not to rip into the analyst community too much, it's embarrassing for them already, where they've had to cut their price targets. But the most bearish note I've seen came from the company itself in a shareholder letter. I think that was the most bearish note from everybody. 4 factors as to why they're struggling. The first factor, increasingly clear, the pace of growth into our underlying addressable market is partly dependent on factors we don't directly control. I mean, Michael, right there is a growth company saying we've gone X growth. So for an analyst now, what kind of multiple do you have to put on a growth company that's gone X growth?
Well, John, you know me well, and we looked at cash flow and earnings, right? And I had a problem in 2020 because I couldn't go to some of the parts, revenue multiples, DCFs and 20-year DCFs. Like, you have to look at earnings and cash flow. That's a shock, right? Earnings and cash flow. And the problem is on cash flow, it's just not there because the business doesn't generate a lot of cash. Earnings, you're getting closer to maybe seeing a bit of a floor. That's down a third today. But I think you have, as you know, a rotation into value, more GARP investors, and they look at different metrics. And you have to now, the outlook is so uncertain that I think you have a way to go. And that's kind of our, it's been our view. Now, we were wrong on the way up, but I never changed our way of doing it. We felt like, we were the old men on the street looking at it a certain way. But look, we've seen this before, you and I, and certainly Tom. It's about earnings and cash flow, and we're getting to a different metric, which is not good for a company that's a growth stock.
And this is really, really important. Do you think the street is getting there? You mentioned it just briefly, but do we get away from the obsession with subs on the next quarter, the quarter after that? How long does this take?
It's those downgrades. The people went from buy to sell, or buy to hold, kind of price targets. They can't get up in front of their sales force and clients and then go back to the old methodology, right? Like, that's over. And I think for the rest of the industry, like, you're going to have a hard time selling me on a sum of the parts story using revenue multiples because that's what Netflix has. It's just changed overnight. And I think to your point, there's no going back because of all the downgrades. And the market has finally seen this the past year or so, has rethought how they look at these companies, which to me is healthy.
Michael, just finally, just a final question from me, just on the broader industry and the price of content and the debt loads of this company and traditional media companies as well. This will be treated almost exclusively today by the media and to some extent the South Side too and the investor community as an equity issue, an equity problem. Is there a debt problem here too?
Only if you think we're going into a recession, right? If you think that we're heading into a 2 or 3 quarter recession where advertising gets cut, don't forget, like, the guys who are transitioning are using the stable business of linear to fund streaming. But if you think linear becomes unstable because of a recession, that would scare me on the debt side. Today, not a problem. But if you think, hey, Michael, we're a quarter or two away from having real troubles on advertising, that's going to be a problem for the debt.
Michael, you've been skeptical for a long, long time, and I know that was painful at times watching this stock surge, but it's paid off eventually in a massive way. Michael Nathanson, thank you, sir, from the team at Moffett Nathanson. The final word from here, the question is whether the company has gotten cheap enough for new buyers to step in. Mr. Nathanson, Michael Nathanson saying we would argue not yet. That stock is down by 34% to 230. Negative in a big, big way. Up next on the program, we'll get to the trading diary from New York City this morning. Good morning. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Five minutes into the session, this stock is down hard. We are negative almost 35% and shaving more than $50 billion off the market cap of Netflix. Netflix down hard, the equity market hanging in there just about on the S&P 500, positive by just 0.02%. And now the pain starts to come through on the Nasdaq 100, negative 8, almost 0.9%. That's the price action. Here's the trading diary. President Biden meeting with the Secretary of Defense and Joint Chiefs of Staff, 4 p.m. Eastern. Tesla and United Airlines reporting after the closing bell. Powell and Lagarde speaking on Thursday. That's one to watch. And finally, another round of initial jobless claims and some PMIs from Europe going into the weekend. From New York City for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is